minutes past 9. We are at 6 minutes past 9, and I do want us to open the session officially. Welcome back. Hopefully, all of you, as you were here yesterday, because today's session is really a build-up from what we kicked off with yesterday. Today, as I indicated yesterday, we are really going to zero in on the QSC tool, which is that instrument that in the packaging of your project application, you also need to factor the QSC, which essentially helps you to work on the numbers and work out the financial viability of the proposed project. Just as yesterday, Tinashe and Larry are here to assist us with unpacking the content. And our expectation is that it is again a interactive session. Please let us ask as many questions as possible and interact with the content in as much as possible. We will allow or open up at various intervals, just like yesterday, with the time to ask questions and receive answers or make comments. But in the meanwhile, use the chat line as well. And if there's anything pressing, please raise your hand. To those of you who are joining with us for the first time, welcome. Hopefully it'll all make sense, because as I say, today's session, it's really a build-up from what we started yesterday. I do not want to take much time. We are anticipating to close the session at 1. If we finish early, that would be first prize. But yeah, we are aiming for 1 o'clock. Tinashe, I think I have given you the presenters right, yourself and Larry, and maybe at this point, let me hand over the session. Thank you.
Thank you, John, and good morning to everybody who managed to make it for today's session. Okay, so just a recap of what we went through yesterday. Essentially, we went through the QuickScan A tool and the QuickScan B tool, and those two documents, the QuickScan A being the organizational due diligence, which from a Strauss perspective looks to essentially do a due diligence on the entity and the projects that are proposed from you as the applicant. And then the QuickScan B covered the technical aspects of your project as well from a due diligence perspective. The QuickScan C, which is what we're doing today, is essentially going to be looking at the financial viability of the projects that you plan on putting into the social housing program. And it essentially has looks at the rental incomes, the operating costs, the development costs, how you put those together, and what you need to do in order to make sure that you put in the correct information into the financial viability tool. So as a starting point, what we'll take you through today is some of the financial terminology that you'll come across in the QuickScan C tool itself, and some of the key concepts that you would need to understand when compiling the QuickScan C tool itself. Then we'll take you through some of the key performance indicators, so essentially the outputs of the tool and what those outputs mean and how you interpret them and what they are supposed to look like, or what the key indicators that the shard looks at. And then we'll then take you through some financial feasibility basics. That will be the actual Excel-based QuickScan C tool, and understanding some of the interrelationships between the key performance indicators. And lastly, I think the best way to understand the QuickScan C is really to see it and to essentially go through a high-level case study, which Larry will take you through when we get to that stage. All right, so just in terms of the financial terminology, some of the key items that you need to understand with regards to the business of rental housing, firstly is income. And income essentially is the money generated from operations, and that includes the cash that you collect from rentals, any other sales that you would do in your housing development, and any other forms of earnings received in that period of time. Important to note is that this does not include the subsidies and loan advances, which are essentially capital receipts. So when we're referring to income, it's just look at it almost as the month-to-month income that you receive from operating the social housing development. A key component of that is rental income, which is money received for use of the property. This is the money that you as the landlord would collect from your tenants for using the particular space for a given period of time based on the lease agreements that you would have initially signed. What we have seen in some social housing entities is that some do have a portion of their development that is allocated towards commercial activities, and essentially that's represented in the form of commercial rental income, which is money received for the use of commercial property. A typical example of that is, for example, in Johannesburg CBD. Normally, some developments will have the floor that level 0, essentially having some commercial spaces, shops or offices, and then if it's a high-rise building, floors 1 all the way to floor 10 or whatever the cases, will have social housing tenants in that case. So the bottom floor or the ground floor, it will yield commercial rental income in that instance. Other types of financial terminology to be aware of is parking. These are parking spaces are created for use by tenants and are charged out at a monthly fee per parking space. So in some projects you may have, most projects actually, you'll have put into place some level of parking arrangement of which that will attract a monthly fee for using that parking space. A vacancy, there's an assumption. This is essentially an assumption of the expected number of unoccupied rentable units, and that's normally expressed as a percentage of the total units. It's quite an important item to understand and to know, because in most properties, in most developments, there is some level of a vacancy rate. Obviously, what you don't want is you don't want a high vacancy rate. You want low as possible a vacancy rate in order to make your project as viable as possible. Two other key financial terminology items in this section. First is escalation. And normally when we refer to escalation, we're really talking about the inflation escalation, and that is something that you apply, for example, to your rental on an annual basis where you'd increase your rent. But it is also used as a key item for understanding the financial viability of for the property owner and for affordability of tenants as well. Then there's recovery of operating costs. So in your project, you will have certain expenses from tenants that come over and above the rental that you could potentially recover from the tenants themselves. The typical ones in this case would be municipal utilities. And in the case of, for example, you don't have prepaid meters where the electricity is prepaid upfront, you would need to then include that in your rental invoices to essentially recover some of that operating costs. And again, also with regards to recovery of operating costs, this would also include the maintenance attributable to tenant actions, such as damaging of property that you would need to recover, the costs that you would need to recover from tenants themselves. Operating income, this is a measure of the net income earned from ongoing operations, and this is after deducting operating expenses from total income. And this is when we do a quick scan C analysis, one of the key items that we look at is we look at your operating income, which is essentially your gross rental minus your vacancies minus your direct operating costs less your overhead costs, or rather the portion of your overhead costs that are attributable to the project, and that's when we get our operating income. When we go, and we spoke about this yesterday, when we go into the committee meetings at the SHA in order to present your application, one of the key questions that we get is, what is the operating income or the operating or even the direct operating costs of your organization? And that gives you a good indication of whether this is something that's viable, not from an operating income perspective. Operating costs also just as important, and these are the costs that are incurred from normal operating activities, and these include direct operating costs and an attributable portion of overhead costs. What does that mean when we talk about an attributable portion of overhead costs? In some entities, we note, and I think yesterday we had one or two individuals who stated that they have other business interests as well. And it may happen, for example, that you have, for example, one finance manager and an HR manager, and they do the work across your multiple businesses. A portion of their services and those services are all called overhead costs. And what you would need to do from a project perspective is to attribute or allocate a portion of that cost, of that overhead costs, to a specific project, and that's what we would deem to be the attributable portion of overheads. Direct operating expenses, and maybe just take a step back, your operating costs are essentially made up of two separate items. The first being direct operating costs, and the second being your overhead costs. When we speak about direct operating costs, these costs relate to operating each building or each project on an ongoing basis, and these include some of the common items you would know: the security for the development of the project, the cleaning, the building maintenance, both short and long term, garden services, building insurance, municipal property rates, especially for the communal area utilities, and other operating costs. There is also a portion of this for utilities, and that will be the cost of municipal services for electricity, refuse, sewer, and water. From an overhead cost perspective, and I gave you the example earlier, but essentially these are the expenses associated with running the company as a whole. The overhead expenses include accounting fees, advertising, legal fees, administration, staff costs, head office insurance, if you have any, telephone bills, and travel and expenditure, all at an overhead level. One of the common mistakes that we see is that some individuals or some people, some applications that we see, they include some of the general institution management and overhead costs, such as office rental, CEO salary, and other general staff salaries into the QuickScan C. You must be careful not to include that, or to a portion, or to at least do some level of attributable portion of those overheads. Only include overhead for a specific project in the QuickScan C, for example, extra head office staff hired to deal with the increased admin. So what that means is that if, for example, you as an applicant find it necessary to hire another head office staff member, and that staff member is then essentially allocated only to work towards the project that you're looking at now, and if that's the case, then that additional staff member would need to be included in the QuickScan C as part of the operating costs. And lastly, well, one of the last ones is the balance sheet. So if you've been running a business up until now, or you've had some sort of business dealings, you'd be familiar with this. But if you're not, the balance sheet is a financial statement that reports a company's assets, liabilities, and shareholders' equity. There's a common formula used in accounting, which is essentially owner's equity is equal to assets minus liabilities, and it essentially provides a view of the company itself, a snapshot of what the company owes and what it sells at a certain point in time, as well as the amount invested by shareholders. Just remember that a balance sheet at any point in time is something that is given at a specific date. On this note as well, so let's assume that you've now got the consolidated capital grant, and you've built your development, and you are running this on an ongoing basis. One of the things that you have to provide to the SHRA on a quarterly basis is what they call a monitoring tool. And in this monitoring tool, it's essentially a tool that is used by the SHRA to monitor the progress and the performance of your project on a quarterly basis. Some of the items that you'll have to put in that from a monitoring perspective is the income statement and also a balance sheet. So you will need to make sure you understand how you put your balance sheet together and the required level of information that you would need to put this together. Normally, most people would do this using an accounting system, but you just need to be aware of what the balance sheet is and what it does for you. Within the balance sheet itself, there are some key sections of the balance sheet. The first being the fixed assets, which are the assets which are purchased for long-term use and are not likely to be converted quickly into cash. And examples of this would be the land that you've bought to build the social housing units and the buildings that you've erected on top of the land for social housing. Current assets, this would be the cash and other debt and other assets like debtors. So these are your tenant debtors. Those would be tenants who would be owing you cash for rental, for example, and trading stock that's expected to be converted into cash within a year. Normally, for projects such as this, we wouldn't expect to see a lot of trading stock. Trading stock is more for businesses that sell goods or commodities. In your case, the majority of your current assets are likely to be in the form of cash and debtors as well. Current liabilities, these are amounts due to be paid to creditors within 12 months, and the long-term liabilities are the financial obligations of a company that become due after more than a year. A typical example of a long-term liability in your case is that if you then put in your application and you have to raise debt finance in order for the project to work, that would be termed as a long-term liability as part of the project. Shareholders' interest and share capital. A shareholder is any person or company or institution that owns at least one share of the company's shares. The shareholder's interest is represented by share capital and reserves. When winding up the business, the shareholders get what is left after creditors have been paid. Hopefully, in your case or in the case of any applicants, there wouldn't be a need to get to the point where you're winding up the business. But again, the shareholder's interest is essentially your shares or your shareholding in the company that you're putting together. Capital expenditure. Capital expenditure is also a key part of the Quick Scan C itself. So you'll see there's a dedicated section within the Quick Scan C that deals specifically with capital expenditure. And capital expenditure, from the Strauss perspective, is broken down into essentially four different items, key items. The first is development costs. Second is the cost of land, the building costs, and professional fees. When looking at the development costs, and Larry will take you into a little more detail when we go into the section to do with the Quick Scan C, essentially is the total cost of land or buildings, including the total construction costs, total professional fees, the capitalized interest during construction and contingency. So this is the development cost is effectively the consolidated view of what you believe you will spend as capital for your project. So the entire cost of the project. Within that, the land costs are typical cost of the land, which is represented by the purchase price and a transfer duty of VAT. And this is now also inclusive of the geotechnical investigations and any legal costs related to the land. In the land cost section, and for your benefit, when you are also submitting your Quick Scan C, you will be required to put in to also submit supporting documentation. For when it comes to land, one of the key items of supporting documentation that you would need to put together would either be your title deed or an offer to purchase. So you need to make sure that the information that you provide, the supporting documentation and the numbers, more specifically on that supporting documentation, correlate to the information that you see in the Quick Scan C. So if you've got an OTP that says that you have purchased a specific piece of land for 10 million Rand, what the assessors do when they assess this is that they verify and vet that the 10 million Rand in your OTP is the same 10 million Rand that you'll see in the Quick Scan C. So you need to make sure that all the documentation that you provide correlates to what you put in the Quick Scan C. In terms of building costs, these are the construction costs for incurred to erect new buildings or refurbish existing buildings. They can be a single line item if a contractor takes responsibility for the construction, or multiple line items if the company engages in various contractors for different pieces of work. So just a note here, when it comes to the building costs, there are many ways in which you can many different strategies that you can use to develop your land, of which, for example, one in this case that the presentation mentions is to hire a contractor who gives you one fee and then they do everything for you and they build for you. Or you can go and you can get multiple service providers to do the work for you. When it comes to the Quick Scan C, the level of detail that you put in is extremely important. So although you may have, for example, one fee that you've been given by a contractor to undertake the piece of work, you will be, however, required to break that down into more detail in the Quick Scan C itself. So if you are going to go down that route, please make sure that you get the level of detail that you need to put into the Quick Scan C. What other applicants do is that they get the contractor to assist in filling that specific section regarding capital expenditure in the quick scan C itself. Professional fees, again, also in preliminary estimates of construction projects, professional fees are generally calculated as a percentage of the final building costs, and those generally range between 10% to 20% of the final construction costs. But for social housing, and how we know this is through, because of all the historical data that the SHRA has acquired over a period of time, they have a good feeling for what the professional fees should actually be for social housing projects. And that normally stands between 8.5%, 8.5% to about 12.5% of the final building costs. What do we mean when we talk about professional fees? These professional fees include people you might have hired, including architects, structural civil engineers, quantity surveyors, town planners, and project managers, and also financial modelers or financial advisors as well. Those are sort of some of the key people that you would need to get your project going. From a funding perspective, I think yesterday, we did mention that, the two things, one of the two things that make a project fail or make a project succeed is essentially their access to land and the level of funding that they have in place. So funding is a vital part of this, more so the equity financing if you're an ODA, but even if you're an ODA or a social housing institution, one of the key items that you will need to do is you're going to need to be able to access some level of funding. And funding is the money that lenders and shareholders provide to a business for short-term and long-term needs. In the social housing environment, some applicants have had access to grant funding in the past. It's not very common to have grant funding in place, but there have been entities that have been able to get to this stage by having some level of grant funding. If you in addition to grant funding, and if you're a private company, you've put in your 20% equity contribution. And just as a reminder, when we talk about a 20% equity contribution, it comes in the form of cash or in the value of the land that is unencumbered. In other words, you don't have a mortgage bond or a loan against that piece of land. If you've got those two pieces of funding, the next level of funding that you're likely to get is some level of debt financing, and that probably also constitutes anywhere between 10 to 20% of your total project funding. The typical institutions that fund that provide funding in this space will be your National Housing Finance Corporation. We have seen some deals come through from the National Empowerment Fund, and this is quite recent, so it's a new entrant into the space. International Housing Solutions has also provided some level of financing in the space as well. And then TUF, which primarily funds inner city buildings in Johannesburg CBD, has also provided some financing. If we just from a financing or funding perspective, debt financing perspective, again, also the commercial banks have dabbled a little bit in providing financing in the space, but it's just a word of caution here is that the terms that we have seen when some of the assessments have come in haven't been as favorable as the ones you would get from the NHFC or from TUF, but those are some of the different institutions that you can also go to get some level of debt financing. All right, so I spoke about this in the previous slide in terms of the funding sources. So there are essentially 4 types of funding services. First is equity, which is the owner's equity, the owner's cash, and you would need to provide proof in the bank account. When it comes to the submission of the Quick Scan C, you will be asked to provide this proof, and that proof essentially will mean that you need to provide a bank statement that has the value of the 20% in that bank statement in order to prove that you've got that equity contribution. If it's in the form of land, one of the key items that you will need to produce is a valuation report. And if the valuation of the land doesn't meet the full 20%, you would then need to provide the balance in cash in order to show your equity contribution. And this is only if you are ODA/private company. Another funding source is debt financing, debt funding that we've spoken about now, and that normally comes from a commercial lender. And the type of documentation that you would need to submit for funding here would be, in some cases, would be a term sheet. However, in the beginning stages of your application, normally what's needed is a letter of interest from the debt funder, and the term sheet is something that you can provide at a later stage. And then a grant funding, this comes from the SHRA and from the provincial, and essentially that's what this session is for you to get access to the consolidated capital grant agreement. And lastly, in funding, some institutions have received some level of donation in order to undertake the financial, in order to undertake the development. I'm going to stop on this last slide whilst I just finish this, and then I'll open the floor for some questions. So in terms of the social housing consolidated capital grant, so there's been a circular that's been circulated on as of the 7th of September in 2023. So this is a couple of months ago. And essentially the circular has now indicated that the grant now sits at about 400, and the consolidated capital grant now sits at about 426,308 Rand. That 426,000 Rand is made up of two amounts. It's made up of a restructuring capital grant whose standard grant quantum is about 243,000. And then it's also made up of the provincial grant, which is about 183,000. That gets you to the 426. So this is the amount of grant funding that you would get on a per unit basis. So for example, if you were making 100 units, you would get 100 times 426,000 as your capital grant contribution. Your development costs are likely to be much higher than that, and that difference is what you would then fund with either your own equity financing or debt financing if necessary for your project. Okay, that was a lot of speaking in terms of financial terminology. Let me open up the floor and let me get some of your questions. John, please could you open up and take some questions?
Okay, the mics have now been enabled. Let's see if there are any hands, questions, comments. We'll also just take a few in the chat line if there are any. So you have an opportunity to pose questions or comments just on the last few slides that we've gone through. Go ahead, Figile, unmute yourself.
Good morning, everyone. Thank you so much for the presentation. And I like the way you presented. You took a fear out of the numbers from some of us. But now there is a slide where you were talking about costs and indicating that certain costs cannot be included in the quick scan C. Does that mean they cannot be covered by the grant at all, or are they covered under operational? I'm asking in terms of, we spoke about company structure and the vehicle that one uses yesterday. And if one has a dedicated company that solely deals with social housing, so all the expenses are directed to the meeting of the objective of the company, where else then does one cover those costs? If you can just clarify me on that. Thank you.
Thank you, Fikile. All right, next question. I'll answer all questions at the end. Any other questions?
Gabelo has just put up his hand. Please unmute yourself.
Thank you very much, and thanks for the presentation. I wanted to ask about the contractors as far as it comes to the building costs. It was mentioned that you can use one contractor. They do the work from start to finish, or you can use multiple contractors. So my question is, based on the data that you have with the SHIs that you have, what has been the approach, like the best approach, like the one that works? Is it where an SHI uses one contractor or multiple contractors? Thank you.
Okay, thank you, Kabelo.
Was that Tanasha?
Yes, I got that. Thank you. Any other questions?
There isn't any on the chat line, and Kabelos would have been the last hand on this one, unless if there's any other. I think let's just go in the answers.
All right, thank you. Okay, Fikile, you've asked about what are the costs that could potentially be excluded from well, essentially the information that you put into the quick scan C. So the answer to that question is that it depends on the type of cost. If it's something, if you've got ongoing costs that you are going to be incurring on an ongoing basis, those would typically be operating costs. And those types of operating costs aren't those that would be covered by the capital grant. That's something that you would need to fund from your operations or at an operational level. And I think you're directing to your question. So I think you've got costs of setting up the company and making sure the registrations are done and all of those different types of costs. I think that's where you currently are. It's a bit of a tricky one, but there are sections within the quick scan C itself under capital expenditure where some costs you can capitalize. You just need to provide a little more detail, and some costs can be covered as part of your development costs on a capital level. But again, you'd have to be very careful in defining what is a capital cost and what is an ongoing cost. If it's an ongoing cost, then I would say that that's more of an operational cost. But if it's a once-off cost that you would need to establish some of these, to establish the groundwork for getting the social housing development off the ground, you could potentially see those as being capitalized and included in the quick scan C. And Kebelo, your question around contractors in terms of which is the right or which is the best strategy to use, is it using one contractor or is it using a couple of contractors? There's no easy way to answer that question. I think it really is dependent on how you want to operate your own organization. We have seen in certain cases very successful projects being put together where they've used one contractor, but that contractor has been someone who's been highly experienced in the development of social housing, and they've got a track record in the space, so they know what they're doing. In other cases, we've also seen successes where multiple contractors have been used, but it all really depends on how you plan on putting your project together and your team together and what you have at your disposal. But I think in all cases, the only one thing that you want to do is you want to ensure that you've got the right people who provide you the right level of quality. If I look at the historical trends, like I said, it's very difficult to state which has been the best method to work with, but there have been a combination of both people using one person or people using a range of different contractors. Sorry, I don't have a better answer for you there. I don't know, John, have you come across a model that seems to be working much better between one versus using multiple? Or Larry?
I can help here. Yeah, it all depends on who your best service provider would be, and that's sort of gained by tough experience. I've seen cases where you've got where you put your project out to tender, and everyone's very expensive and one person's much lower, and you think, are they going to be able to deliver the quality? I can think of one case where the person who was lowest by miles delivers excellent quality and comes back for more, delivers subsequent projects. So in that case, they're very lucky to have a service provider like that. But generally, the construction industry is about making money. So they tend to have high profit margins. So that's the challenge, is to keep your costs down through competitive tendering, firstly, and then finding somebody that you can use time and again because they build up experience. That's if you're going to employ a single contractor. Some people might comfortable with managing the construction process themselves, if they've got those kind of project management skills in their own team, and then they can engage multiple service providers for different parts of the construction. It largely depends on the mix of skills you have in your organization and the local skills in the construction community around you. Hope that's helpful.
Thanks,
and then
Larry.
one other point about the overheads. If you're doing your first project, then all your overheads would have to be covered by that one project, which makes it very challenging for a startup. So I think in those kind of cases, I don't know if the SHRA provides any assistance in terms of a company setup, but it might be worth asking, and the more people that ask, maybe there's something to help people with a startup grant. I know they were in place at one stage and then they were discontinued. I'm not sure what the current status is.
So yeah, just maybe to get in on that last point, Larry. Last week, in fact, but I guess for the benefit of those who were not with us in the introduction, we have a pot of support grants that we also administer. So outside the capital, the CCG, consolidated capital grant, which is the main pot of money for the construction and what have you. We have this set of money that we administer, in fact, within the sector development side of the business, which is called IIG, the Institutional Investment Grants. In total, there are about 5 grants there. If you allow me, in fact, I think it might be beneficial to quickly go through at a high level on those. So directly to your last point or question, there is one grant under the IIG called the pre-accreditation grant. So essentially, the grant was set up to assist those aspiring social housing institutions in the main to apply for accreditation and to take care of those initial costs in terms of building in-house capacity. There's about 250,000 top of my head that one can access in terms of professional service. So it would not be straight out cash that is paid to you as the grant applicant and grant recipient of that. So that's the first one, and to a certain extent, it does take care of your setup costs, so to say. It would look at, for example, helping you to develop necessary policies and procedures, and totally the whole packaging of your application as an institution. There are, of course, some pre-requirements that you must meet to apply for that. The second one, which I think might actually be of relevance to this session that we're having today and yesterday, is one which we call the Project Feasibility Grant. Project Feasibility Grant, and I think what we can actually do is also include a policy document which actually outlines in great detail these 5 policies that these 5 grants that I'm now talking to. So the Project Feasibility Grant, one can apply for up to 750,000 worth of support. And it was mainly created to support projects that have been registered into the SHRA's pipeline, and those projects are stuck in the pipeline. They are not ticking all the boxes so that they can go through the approval system. It could be, perhaps, as an example, a need for an updated market demand study, or a phase 1, phase 2 geotech report, or traffic impacts. So it's a whole range of things that this pot of money can sort of assist in unblocking a project that has been registered in the pipeline so that it can move through the approval system. And again, there's a process there that one would need to follow for such a project to be considered for that. The third grant that we administer, it's what we call the staff gear up grant. Staff gear up grant. There, one can access up to 500,000 in terms of funds. In fact, of all these 5 IIG grants, this is the only one that you would have money directly dispersed to you or to your bank as a grant recipient. And social housing institutions or ODAs can apply for this grant. And essentially what it does is we come from a base that you are taking on a new project as an SHI or ODA. And at that point of taking on these units, you have not realized the first income streams in terms of your rental and what have you. So at that point, we are then saying the staff gear up grant is that is those resources that would then enable you to put in place operational staff that would facilitate that whole tenanting process and phase. So you would, this money enables you to pay for salary cost or staff cost of your client liaison officers, the marketing officers, your credit controllers, and so forth. So that layer of operational staff that you require at that initial stage of taking on the units. And as I say, it's about 500,000 rents that one can apply for there. The fourth one, quickly, is the one called the General Capacity Building Grant. General Capacity Building Grant. It really was set up to address a whole lot of capacitation needs or gaps that are in the sector. So, for example, for payment of research work that has to happen, or training drives that we do, for example, such as this one. But beyond that, in some cases, we've used this money to assist a new SHI that does not have in-house capacity. For example, let's say you are now signed and you have the CCG and you are at development stage, and you don't have the development management capabilities. So we would use this money to try and support you with a resource for a development manager, as an example. Now, the last one, which we call the Remedial Action Grant, is that grant that says, once you have the units and now the people are staying in the units, and now there's an expectation that you will report to the SHRA on quarterly basis on the affairs of the project itself and on the affairs of the SHI itself. And that happens on quarterly basis. When you submit those quarterly reports, SHRA does the analysis of the performance and the health of that project and the SHI. And where it is picked up that you are struggling with certain performance benchmarks, because there are about 5 benchmarks in total. Amongst others would be your rate of rent collection, how well are you doing in there, how well are you managing your vacancies, and that there's a certain benchmark that is set in there and so forth. So where we see through these quarterly reports that you are struggling in meeting some of those benchmarks, we then deploy these resources in terms of the Remedial Action Grant to try and resolve those performance failures or performance difficulties. This is all the support grants that says before the SHRA can take a much more harder stance, because the Act itself allows and empowers the SHRA to take a harder stance where as an SHI you are failing, or as an ODA you are failing despite all the support and initiatives that have been provided, such as putting you under administration, taking the stock and so forth. So these are all the grants that are then put in place to facilitate the support generally of the implementers and the sector at large. I thought that's just a quick. Let me give just a quick rundown on those. We are available to give much more detail, but as I say, I will include. There's a nicely easy to read policy document on these grants as well that can perhaps you can go through at your leisure and engage us if you have any more questions on that.
Thanks, John. That's
that
very
helps.
helpful. Thank you very much, John.
Sure. Okay,
right.
there was one. Sorry, Tinashe. There was one last question on the chat line from, I think it is James. He says, "Thanks for the great presentation. You mentioned that we can work with the contractors in filling in the QSC. Do you, as facilitators, assist in this process, even as consultants? If yes, it will. If yes, it will be helpful to get a list of consultants. Thanks."
John, I think maybe you'll probably best answer that.
Yeah, it's a harder one. I think, however, a position that we have taken is not to do any referrals as a SHRA, because remember, we can't be a referee and a player at the same time. People have taken an opportunity to engage other consultants, such as Learning Strategy, that is facilitating the session for us today and from yesterday, and any other consultants that we have brought forth in facilitating initiatives such as this one. So, James, that would be entirely in your, sorry for that. That will be entirely in your powers to follow up with anyone else. But yeah, we can't make those referrals.
Thanks, John.
Sure.
All right.
Can I just add a point there about that? If there are a number of consultancies who know the quick scan C, who also do the assessments, but the rule is that if you can't sit on both sides of the fence, so either if one of those consultancies is asked to assist with a quick scan C, then they can't be assessors for that project. So that's only fair to everybody. So it's a matter of choosing which side. If you bring somebody in to assist you on your project, then that person's not allowed to be an assessor as well.
For that project, yeah. Okay, thanks, Larry. All right, let me move on to the next section. So the consolidated capital grant, this is just a reiteration of the slide that we had previously, just to show you that this is on the right-hand side of the screen. That's the circular that was put out on the 7th of September. And you can see, if you look at the bottom right table, it shows you what the adjusted quantum is for the institutional subsidy, about 183, and the RCG, the restructuring capital grant, at 243. And that's what makes the total consolidated capital grant of 426. There have been, as part of the same circular, a couple of other changes were also noted. The first is that the quality must be improved. As part of your submission, you also are now going to be needed to provide some level of green solutions, and these could range from the inclusion of solar panels, borehole water, burglar bars for people living with disabilities, and all other cost savings for the future social housing tenant. And this, I think, could also include Wi-Fi as another example. The 20% equity requirement for ODAs remains, and if the grant reduces, then the grant does reduce if the consolidated capital grants makes up more than 70% of the development cost. So that's quite important. If your development cost is, for example, 90 and you, or let's call it 100 Rand, the CCG cannot be more than 70 Rand of that 100. Actually, what it means. And if it does get to that point, then the grant does reduce to be less than 70%. In terms of the updates to the Quick Scan C, if the project was registered in the pipeline before the 7th of September, you will be required to submit an updated Quick Scan C. The Quick Scan C itself has changed. It's been updated to include some of the items that were published in the circular on the 7th of September. In terms of the minimum specifications required, BRCs, stoves, recreational facilities, fiber, Wi-Fi, and others have also been stated there. So you can have a look at the circular to get more detail around that. And there's also been the inclusion of what is called nano units, and those units should make up less than 5% of the total subsidy amount the subsidy amount for nano units is currently being finalized, and I'm sure it should be put across to you in future communications. Other grant conditions that have changed, there are no geotech variations allowed now, and to accommodate adverse geotech conditions, and the total project costs must be ready at approval. What does that mean? That means you now need to have a priced bill of quantities, phase 2 geotech investigation and foundation designs, and also alignment to the revised norms and standards. So I think one of the recommendations that'll come out of the session is that you please need to go and read that circular in a little more detail so you can understand some of the changes that have happened and some of the changes that are proposed to happen in the future as well.
Can I just add a point there?
Yes.
There might be some people in coastal areas as part of this training session, and there always used to be the SCCCA, Southern Cape Condensation Grant. That would fall away as well under this stipulation that no geotech variations are allowed. So you're losing that little grant that you would have previously received. Thank you.
Larry. Okay. All right. I think what I'm going to do just after this last slide, we're going to take a quick 5-minute break, and then we'll continue with the key performance indicators. So lastly, just the last section of funding terminology, share capital. The delivery agent may contribute its own equity to the project. These sources of funding are to be declared at grant application. Again, we've spoken about this, but ODAs are required to provide 20% equity. In terms of long-term debt funding, the confirmation of the approval in principle of a debt funding arrangement by an approved financial service provider for a project is a precondition to the submission of the RCG application if the development costs exceed the grant funding amount, 20% plus minus 20% equity for ODAs, and by which development exceed grant funding for SHIs. I think the main takeaway there is that when you're putting in your application, you would need to make sure that you have an approval in principle. So this doesn't necessarily have to be a term sheet, but it has to be a letter from an approved financial service provider indicating that they are aware of your application and they have given approval in principle, and you will then be required to submit a term sheet at a later date. All right. I think if possible, let's take a 5-minute break. I see the time now is 9:59, and then we will be back at 10:05. Thank you. Okay, welcome back, everybody. It's 10:05 on my clock, so I'll start now with the next section, which deals with the key performance indicators. Larry, please let me know. Can you see my screen?
Yes, Tanashi.
Okay, thank you. All right, so there are a couple of key performance indicators that are quite important to be aware of from a quick scan C perspective. The first is the debt service cover ratio, which measures the cash available to service debt, interest, and capital payments. And in most of your applications or most of your projects, there is a component of your financing that is attributable to debt financing. And this is one of the key formulas that the Shroud looks at when measuring or monitoring your project. The formula for it, and this is automatically calculated in your quick scan C, dependent on the information that you've put and the numbers you've put in the actual tool itself. But essentially the formula is as follows. It's your gross income less your operating costs that we've spoken about earlier, the direct and overhead costs, and that all of that is then divided by your total debt service costs. So remember, essentially your total debt service costs are a combination of your interest and your capital payments. So when that debit order comes off your bank account for the bank for the debt, that amount that comes off, has a portion of it is allocated towards interest and a portion of it is allocated towards capital payments. The SHRA uses a benchmark of about 1.3 when measuring your debt service cover ratio. Another key performance indicator that the SHRA looks at is the internal rate of return, and that's essentially used to estimate the cash flow return on capital invested in the development. It also measures the profitability of an investment based on return on invested capital. The IRR, the rate that the IRR must exceed a specific minimum rate called the hurdle rate. So this is the minimum that it needs to be. And for the SHRA, it's normally at prime overdraft rate plus 4.5%. So if we look at the current prime, which is currently 11.75%, if you add 4.5% on top of that, you get to a current hurdle rate of 16.25%. And again, remember, this number changes as the prime interest rate changes as well. The operating cost per unit per month, and these are the costs of operations for each unit per month. So it's all your operating costs. And essentially how it's calculated is if you take the total of your operating costs, and this would be for whatever it is that you're spending for security, for gardening, for maintenance, even your overhead allocation as well, for all those members of your team that are at head office level. If you take that total cost and you divide it by the number of units that you have, and then you divide that by the number of months in a year, you will get an operating cost per unit per month. Now, before that, the benchmark that the SHRA looks at sits at about 1,350 per unit per month. We know that there have been escalations in the past, and I think right now it sits at about 1,600 per unit per month. So when you're looking at your operating costs and you're trying to figure out, am I operating costs in line with what the SHRA expects, or am I below it, or am I above it? The number you want to compare yourself to is the 1,600 Rand per unit per month. From a maintenance perspective, another key performance indicator is the maintenance as a percentage of development costs, and that normally should sit at about 1.02% of the development costs. And this will normally come in the form of either expenditure that you've used on the project, as well as a provision on top of the expenditure to make up 1.02%. Keep in mind that this excludes VAT and financing costs when you're calculating your development costs. Your development costs themselves also is another benchmark, and the development cost, as we had mentioned earlier in the financial terminology, is it's the total of your land plus your construction costs plus your professional fees. Now, the SHRA also has a benchmark for this as well, and this benchmark has essentially been calculated based on historical data. So this is not a thumbsuck number. This is what they know these projects is roughly cost, plus or minus. It does vary depending on where you are in the country. For example, there might be a bigger cost if you're in the coastal areas in comparison to in Johannesburg, and the different typologies that you might have. For example, refurbishments versus starting from a greenfields development. But on average, we know that the increase in the CCG makes development costs of about 530,000 Rand per unit financially viable for both social housing institutions and also for ODAs. So that's the number. If you can get your development costs in and around the range of 530,000 Rand, we believe that your project, if efficiently done with the right costs and the right people, should be a viable item to pursue. From an operating perspective, there are some key performance indicators. The first we spoke about earlier is the vacancy rate. Most SHIs currently are performing between 5 to 10% vacancy rate, but the best practice is around 2% or less. A bad debts provision also, the quick scan C makes automatically calculates a bad debts provision of about 3.5%. But again, very similar to this, the best performers normally require lower provision. If you see yourself in your project getting to a bad debts provision of above 3.5%, it may be a need for you to relook at your processes and reduce that provision to get closer to 3.5 or less. And lastly, the cost to income ratio. Normally, the benchmark number for that is about 50%, but that norm does vary according to the building type, the condition, and other factors to get to anywhere between 40% to 60%. The lower it is, the better. And then I think this is the last operating indicator is the rent in arrears. It's also another very good performance indicator is the amount of the rent arrears in the form of the total rental debtors. High-performing social housing institutions, so institutions that are doing very well, have generally a low arrears due to efficient collections and good care of their tenants and property, resulting in tenants finding less reason to delay payments. So I think it's quite important to maybe dwell on this point. And I think, John, from your experience, you'll also be able to shed some light in here. The projects that are currently struggling in the social housing program are those that have very high arrears. And those high arrears, if you look at what's caused that, it's because they have a very inefficient collections process, and some of them do not take good care of their tenants and their properties. Eventually, people will not pay rent or will pay rent late, and you can't collect your rent at the time. And normally once that happens for the first time and tenants can see that they can get away with it and so forth, it becomes a trend, and then your project goes into a less favorable arrears status. So you want to make sure that you're able to collect your rental on time all the time. At the time of project funding assessment, this cannot be calculated for the projects because you have no tenants at the time, but the entity's historical performance on its existing portfolio will be a good indicator to let you know whether there's a good collection process within the organization. Okay, I'm going to stop there. I'm not sure if we should take questions. This wasn't a long section, but perhaps we can. And then what we'll do after the Q&A session, I'm going to hand you over to Larry, who's going to take you through the financial viability basics. Thank you.
So if there are any questions, comments, now is the time before we switch on to another section. Are there any hands? Are there any takes? I don't see anything coming up. Tina share, and neither can I see anything new on the chat line. So I guess we should just forge ahead.
Okay, thank you. I'm just going to unshare my screen. And Larry, do you want to share your screen from your side so you can control the presentation?
Okay. Do you see the 5 steps of feasibility costing there?
Not yet. My screen is still
Not
blank.
yet. Okay, I'll have to share one more time. So I'll stop sharing and then I'll share it again.
There we go.
Okay.
Thank you.
Do you see it now?
Yep.
Excellent. And we'll make it a bit bigger by putting it on presentation mode. Where's the presentation mode? From current slides. Okay. Does that come through big enough now? Yeah.
Yep. Thank you.
Yeah. Right. Okay. So well done, Tinashe. You've explained those well enough so that no one has any questions. So it's either that or everybody's asleep already. We'll try and keep you awake and alert
I
to
hope
the
not.
next
I hope
session.
not. Okay.
Okay. The next, we're going to go through do we have a question here from Isaac?
Isaac, your mic has been enabled. If you just unmute yourself.
Hi, good morning, Tinashe. Good morning, everyone. For me, I think it's just a clarification. I joined in late, so I may have missed that part. Please excuse me if that's the case. I noticed on the capital, on the grant, the CCG, that it's broken down into two components. There is the one component of 200 and something, which is the one that is approved at SHRA. And there's another component which you are talking about. It must have been approved already at the provincial level. And I think this is new information for me. I just need further clarity there. So does it mean that you submit an application at the provincial office first to get an approval for the first 200 and something? Then when you have that approval or confirmation in place, you then approach the SHRA for the second component of the grant. Thank you.
Okay, thank you, Isaac. Yeah, that's how the system used to work. I'm not sure exactly if there's going to be a change to that process with this new circular that went out in September. That has not yet been advised. John, do you know if the process is going to change?
No, look, I think back in 2000 and sure, now I probably would get this wrong, but it was one of those reforms that in trying to get to some level of efficiencies, because you're right. In the past, it used to be a dual system where an applicant would have to engage the province and at the same time the SHRA. But all this was then consolidated. This is why we now have a consolidated capital grant. In other words, the RCG and the institutional grant from the province being brought all under one. And currently, all that approval it's happening at the SHRA. The only thing that you do through the province is, which is quite critical, which Tinashe touched on yesterday, Isaac, was making sure that your project, before it even gets through the approval system, it must receive that approval, both at the municipal and the provincial spheres of government. And you have a structure called the Provincial Steering Committee, where such proposed projects or potential projects are presented, or you will be offered an opportunity to present it, and then you get that approval there. But yeah, at this point, all the consolidated capital grant has actually essentially brought those two components under one, and that there's only one approval therefore for that reason. I hope that helps.
Thanks, John. Okay. So, Isaac, you happy with that? Can we move? Can we proceed? Okay. All right. So we'll go ahead then with the next stage of the presentation on the basics of financial viability. We'll go through a few slides on the sort of technical stuff, and then we'll get onto some of the figures and how to fill in the quick scan C later. So in the initial stages, you're doing your own feasibility study. So you first estimate your total development costs. You can get, if you're that far advanced, you can get a quantity surveyor in at that stage. Your very initial stages will be sort of, we used to call them cigarette box calculations, simplified calculations just with high level costs. But your quantity surveyor can help you with your more detailed cost when you reach a certain stage of your planning, and they can also get involved with your cash flow projection during your construction. Not so much with your cash flow projection during the operating phase. So you'd use a quick scan C model to estimate your net income, where you've entered your rentals, you've entered your operating costs, you've entered your loan repayment terms, all of that stuff. So your quick scan C model produces your estimated net income, your return on investment. Well, the cash flow projection is also part of the quick scan C model, so that should have a yellow arrow as well. And then you also do a risk analysis that forms part of your application as well. It's important to understand the relationship between the different financial KPIs. So that's got many components to it. And we'll go through this diagram one by one. So if we're starting at the top left, you've got your gross development cost. Those who are VAT registered can get a VAT reclaim up to the value of, well, they can claim VAT on the amount of the subsidy, because the subsidy is zero rated for VAT. So it's that pours in from the top left. We deduct the subsidy, that gets us to a net development cost. And then we're looking for loan funding. So that's the next arrow down the left-hand side. And then out of the loan funding comes interest and loan repayments. So all our capital stuff is down the left-hand side. All our operating stuff is along the right-hand side. So we now, to pay off those loan amounts, we are earning rental income, deducting project operating costs, deducting attributable head office overheads, getting to net operating income. Some of the financially minded people also refer to this level as EBITDA. It's earnings before interest, tax, depreciation, and amortization. So it is effectively your cash profit from your operations. And that's an important factor in this funding model. So to get to our net income, we deduct our interest from our net cash operating income. That gets us to our net income that you would be used to seeing on your income statement. Right, and then the ratios that are key performance indicators that Tinashe would have told you about. The first two indicators were independent, were the internal rate of return. So that is calculated by taking your net cash operating income and dividing by your net development cost. And then the other important, and that's the one that needs to be at your borrowing rate, prime borrowing rate plus 4.5%. So you need to have an internal rate of return of at least 16.25% under the current financing environment. The other very important thing in assessing financial sustainability is the debt service cover. So you see there, we calculate the debt service cover by using that same cash operating profit and dividing that by your loan repayments. And your loan repayments here consisting of interest portion and the capital repayment portion. And that factor has to be at 1.3. That means your cash profit generated out of your operations from your rentals must be 1.3 times your loan repayments. So there's a buffer of 30% on top of your loan repayments that you need to maintain. It's funny how all these financial things fit together. You'll generally find that if you're missing on one of these key performance indicators, you'll be missing on most of them. It's just how things are for some reason, which is further indication that these measures are set at roughly the right sort of measure for financial sustainability. There's a direct relationship between those who don't meet the debt service cover ratio of 1.3 and those who end up in financial distress. If you're meeting your debt service cover, you generally are running a well, your operations are going well. So you see that all your activities, if you've got a high bad debts, for instance, you're not going to be generating enough cash profit to repay your loans. So your loan repayments are generally a fixed cost. You've always got to make sure that your operations are being run well enough to be able to pay your loan repayments and have a buffer to cater for any contingencies that might happen. So that's an important concept to understand and to take away with you, to understand the link between running your operations well and your ability to repay your loans. That also puts a premium on what your development costs are. So if you're spending too much on your development costs, those high costs are going to flow all the way down, down the left-hand side, and you're going to end up with too much loan funding, and your loan repayments are going to be too high to be sustained by your operations down the right-hand side. An important figure to remember is that generally, we find that there's a cap on how much loan funding you can take, and that happens to be around about 100,000 Rand. So if you take your subsidy into account at 426,000 Rand per unit, you should not be developing for more than 526,000, or we're rounding it off to 530,000 to keep things simple. So when you get your first estimates of your development costs from the quantity surveyor, look at them with a skeptical eye and make sure that your costs are going to come in within these parameters. So you don't want your cost to be more than 530,000 as a social housing institution. For ODAs, because you're providing a little bit of equity yourselves, you might be able to push that limit higher. So you generally would be able to develop higher spec units if you're an ODA than you would be able to if you're an SHR. But you would have picked up in that circular that Tinashe went through that you are expected to deliver a high quality unit, and you've got to put in a whole lot of extra stuff as well. So the cost pressure is still there to keep it within that limit of subsidy plus 100,000. So let's move forward from this. Okay, we're getting into the quick scan C model, just taking you through first with the main chapters of it. So there we've got the ownership structure first. If you're an ODA, you're normally a private company, you normally pay company tax. If you're a social housing institution, you're normally a not-for-profit company. You have got a company tax exemption if you're declared as a public benefit organization, a PBO. It's not automatic that you will be a public benefit organization. You have to apply to SARS for PBO status. They will assess your setup, your memorandum of articles, and company documents to see if your purpose is for public benefit purposes or whether you're there to make a profit yourself. So you need to get that through to become tax exempt. SHIs will have a motive for the benefit of the tenants in the community. ODAs generally have a profit motive for their own profit. So that's why the SHIs can be declared as public benefit organizations, but you have to apply for it. Then we've got the quantity surveyor feasibility costing. So there you've got your land cost and legal fees involved in acquiring the land, construction costs, professional fees, and any other development costs that come in. So this would include your capitalized interest, would include your NHBRC fees paid at stages of development. Then we've got the indicative debt terms. So yeah, you've got the amount of your debt, the quantum of debt is the amount of the debt. You've got your repayment term in number of years. You've got an interest rate, normally prime plus a few percent, depending on the risk that the financing institutions see in your organization. You'll also have arranging fees, typically 1 to 2% of the debt quantum. The quick scan C was developed by somebody who had merchant banking experience. So you've got all the different types of it. They've included there all the different types of fees that you would have added to your capital amount that they're going to lend to you. The income sources are going to be your social housing, residential rental, parking rental, and any commercial rental for shops on the ground floor if you're in a city. You also need to know your basic layout. So you will have to send schedules along with your quick scan C supporting documents with the architect's drawings, setting out your site plans, the number of units per floor, your number of primary units versus secondary units. So primary units being the lower income earners and your secondary units being the higher income earners. Yesterday we went through those limits. You've got to make sure 30% are in the lower income bands and 70% in the higher income bands of secondary units. Then you've also got to show a long-term maintenance plan. So you'll have a maintenance schedule forecasting your ongoing responsive maintenance, making a provision for things that need to be repaired on an ad hoc basis, and your planned or cyclical management, your cyclical maintenance, which will be replacement of certain items at certain intervals in time, and your major repairs. So these will be things like replacing the kitchen after 15 years or bathroom replacement, making provision for those kind of things. Replacement of windows if you've been using steel windows and you're at the coast. So generally you'll be trying to avoid having high maintenance on an ongoing basis. So you might put in aluminium windows instead of steel windows. So you want to keep your maintenance costs low. Right, next stage of the quick scan C is the different worksheets that you need to fill in. So there's, first of all, under the overview, there's an instruction section where you're instructed of how to do your inputs, where you put your CapEx inputs, where you put your general inputs. And then in those tabs, you should only make inputs in the yellow cells. No other cells should be changed. Well, they can't be changed because there's protection on the model. That means you can only change anything in the yellow areas. Any text coded in blue should be adjusted by the SHRA, not the applicant. Yeah, that's normally the subsidy amount and the prevailing prime interest rate at the time of that round of quick scan C submissions. The model has a 20-year time horizon. Most of the lending is based on 20 years. So that we need to see that the project funding is paid off over 20 years. The model, although it does not allow for phase development, you've got 24 months in the capex input section. But if you've got a phase 1 and phase 2 of a development, you would generally have to submit those as separate applications. But you can request assistance from SHRA if you've got a phase development, and they'll advise you if you should submit them as a single application or as multiple applications. So next stage, going on to the CapEx input sheet. There are 2 sheets with green tabs. First one, CapEx. So yeah, you put your development costs in on a line-by-line basis. They have many line items of the usual components of development costs, different types of professional fees and works costs. And we'll go through that in more detail when we get there. So, and it is on a monthly basis, so you would have to estimate what you're going to be paying every month. Yeah, your quantity surveyors cash flow during construction would be the basis of a lot of these inputs when it comes to the works costs. Then we've got the general input sheet, next green sheet, which is where you put your project operating information and the parameters for funding structure. There's a detailed list of operating costs, and we'll go through that as well when we're working through it. So we've got the important sheet is a summary sheet where all of the results flow into the summary sheet, where we've got the KPIs, the internal rate of return we've spoken about, maintenance expenditure as a percent of capital costs. It's got to be at least 1.02% of the capital cost per year. Then we've got our monthly residential maintenance cost per unit and a minimum debt service cover ratio. There are many other tabs. Those are in grey. You can't make any changes on those tabs. Those are just showing how the information flows through the model and how the calculations are done. Okay, so let's move on. In terms of navigating through the quick scan C, section 1, project information. So project name, your ownership type, your company type, your location, details about those kind of high level details. Second box is your financial information, and yeah, you'll put in your equity contribution, your shareholders' loans, and your debt terms. Third section is the revenues, the allocation of units between primary and secondary, your residential rental, based on your rent quote, which we'll get through the definition of that. Enter your parking rental and commercial rental as well. Then we've got box 4 is your your direct operating costs and overheads. And so these are your operating costs like cleaning, maintenance, property management, head office costs, accounting costs. Then we've got box 5 is your capital expenditure, land costs and construction costs. And all those factors flow together to make the summary of key parameters. So yeah, you are decided that determines whether you're on compliant or non-compliant parameters. If you discover that your first cut of your model inputs produces non-compliance with the key parameters, you then need to go back and make adjustments in these different blocks here. Remembering that the information flow that comes through this document here, that gives you an idea of what you're going to change, what will come and what will affect your key parameters. So that funding flow is the same as this diagram, but in more specific aspects. Right, there's some model terminology used in the model. First one is rent quote. That's the maximum amount of monthly income that can be spent on residential rental. Should only be adjusted in the model template after discussion and permission from the SHRA. There's some pre-set figures in the QuickScan C. So if you want to alter that, you'd need some justification to be provided to the SHRA. Generally, your lower income bands can only afford a lower percentage of the income being spent on rent, and your higher income bands will be able to afford a higher rent quote percentage. There's the next term is the short-term grant retention facility. The SHRA model requires for each drawdown in a project, 10% of the drawdown is retained by the SHRA and released on completion of the project. So that is like a short-term loan treated like a short-term loan during the construction process, or like a retention as in normal construction practice. The swap costs are this is in the funding section. Cost for fixing the interest rate on the debt facility used should the developer elect a fixed rate. There'll be some costs of putting a fixed rate in place. Generally, most people are on a variable rate, so they won't need to worry about the swap costs. Then there's a tax wear and tear. That's a rate allowed by tax if you're a taxable entity for your wear and tear on your assets and on your property, which might be different to the depreciation allowance that you have in your income statement. And it will comes into your tax calculation. Generally not something that's going to affect your viability much, but it is just to keep the financing factors correct. Right, if we go through the first stage of the project information, the bottom half of this is what the model looks like. So in this case, we have a project name, which we've just called case study. In this case, project commencement date. We enter the construction period, that's in months. So we've said there's commencement date was 1st of September. Construction period 18 months. Construction end date is calculated 31 March 2025. Applicant name, in this case called GQ Housing. Is it an existing SHI? No, it's not. In this case, wasn't. Does the entity qualify as a public benefit organization? No. We've done this on the basis that this case study was done on the basis that it's an ODA. So we can't say yes to either of those. Is it registered as a VAT vendor? Yes, your ODAs would, if they've got property development operations, they would be registered as a VAT vendor. It's not automatic that you would be a VAT vendor, because VAT vendors are people who create taxable supplies. Residential rental is an exempt supply. So you've got to be careful about your operations. If you're only providing residential rental, you would not be able to deduct any of your input VAT, because you wouldn't be registered as a VAT vendor. In this case, project location, you put your province. So in this case, we selected Eastern Cape. Are you a new project or refurbishment project? We've selected new. You'll have little boxes here that you can select these things from. So it gives you that selection choice. Number of stories, we've said 3-story walk-ups. Earth size, we've entered that. Is corporate tax payable? In this case, yes, because we're an ODA. So it's yes is the default. You'd enter no if you're a social housing institution and you've got public benefit organization status. So that's the basic project information. Now we go to the financing information. Right, very small, you might not be able to see the detail that's in those, but from the material that was circulated, there's a quick scan C in there, so you'll be able to see that when you get into the model itself. So in this part, we're providing information about the equity and the debt. Firstly, the equity, capital provided by the developer. So you've got this, that's your 20% you've got to provide. You can put your land value in as an equity contribution there. So that's the first arrow. Your second arrow here is the shareholders' loans. So if you've provided if the shareholders are providing loans to the entity, you would enter that information in that box in the equity section. Now, everyone will have debt funding as well. That's in the bottom section. So you'll have your term of loans, the number of years, normally 15 or 20. You'd enter the amount you're borrowing. So in this case, we'd said we're borrowing 15 million. Then you've got your arranging fees, your commitment fees. Like I said, there was a merchant banker who did this. So they put in all the different kinds of fees that get added to your funding, which is normal financial practice. I think if you're not sure what it is, just use the defaults that have been entered, and don't stress about these. It's just what you won't get a surprise when you get your loan documentation and showing you the different fees that get added. And then once again, it's only the yellow cells where you put this. So if you've got one loan, you'd only fill the bottom left section here. If you've got a second loan, you would fill the bottom right. The next step is on the financing information. Quite a lot of importance attached to your VAT status. Like we said, residential rental is an exempt supply, but property development is a VATable supply. So if you can structure your group in a way that you have a property development entity in your group, you can then get VAT registration for the property development entity. That is as an SHI. If you're an ODA, you can do the same kind of structure, or you can use a company that's already in property development, and you would already have VAT registration, because sale of property is a VATable supply. The attraction of VAT registration here is that you can claim your input VAT on the amount of the subsidy. Subsidy is declared as a zero rated supply for VAT, and that allows you to claim your input VAT at 15% of your development costs up to the amount of the subsidy. So there's a lot of description here which tells us more about it, but basically explains what I've just explained. And we must enter our VAT information here on the basis of what we are. So if we are not a VAT vendor and we're only providing residential rental, these will have to be no all the way down. If we are registered for VAT and we're providing things like property development services, commercial rental of commercial space is also a VATable supply. So we could get a partial registration if we're providing commercial rental. But you would answer these yes or no, depending on the circumstances of your company. So let's move forward. Step 3 is the revenue. So there are 5 income bands that that this is split into, and each one treated slightly differently. So in this example that we're using here, we've got income band of the primary target market 1870 to 6,700, secondary market 6,700 to 22,000. Those are split into smaller bands. We need to cover the lowest interest, lower income band, but we have a split here in this instance of 5% in lower, 25% in the upper band of the lower income level of the primary units. We see the rent quote there is 27% and 29%. So those, and then we would get a minimum rent of 505 or 945, average rent of 725 for the lower band of primary. In the upper band of primary, we've got an average rent of 1479. That's a maximum of 1943. If we looking at the secondary market, we would be starting at rentals of 2,077 per month, going up to 7,700 per month, and an average rental in your upper band of 6,475. The danger here is that in that upper band, we're moving in the space of private rental as well. So if you think you can just load your upper band, well, you're not, for two reasons, you're not going to be successful. Firstly, the SHRA is not going to like you putting all your rental in that band. Secondly, is reality tells you that you've got competition from private sector in that band. You're not likely to find as many in that band. So you're more likely to have higher numbers in your 6,700 to 11,300 band and 11,300 to 15,000 band. So that's why that's why we've got more people likely to be in those bands. And you can push those rent quotes higher for those. You wouldn't generally want to see higher than 30% in your average rental. So we might have, in this instance, might have had to go and moderate some of those a bit. This is just more information about those bands in the way that they are presented in the model itself. So you'll see there you've got the same 5 bands, and you've got a different rent quote there, just in the example that's been used here. And then that translates into, this is a very wide field in the QuickScan C, so that's why we've had to present it over two slides. So we've got your unit sizes, and in the top row of each of those yellow areas, there's a unit size, and then there's a number of units in each category entered below those, following the blue arrows. So, and then this is how it's all summarized. We've got a weighted average rent quote cannot exceed 33%. So you would have seen that other example at 31.5. In this example, we've got 29.5. And so we're within that maximum of 33% overall rent quote. We also have to enter our vacancy rate here. So that was generally between 2 and 5%. If you've got a long waiting list for your properties, you will have likely to have a lower vacancy rate. If you obviously if you would have done your market demand study, so hopefully you will only have to budget for a low vacancy rate.
Sorry, Larry, just to stop you, there's a request before you move very far to repeat an explanation on the rent code. I think
Okay.
it says slide 35 and 36, how it is calculated, or what it means and how it's calculated.
Okay, yeah. The rent quote is the percentage of income that can be covered, that can be attributed to rent. So if we go back to the definition, I'll just scan quickly. So the definition is the maximum amount of monthly income that can be spent on residential rental. In the quick scan C, the rent quote has already been entered by the SHRA. You should only adjust that after discussion and authorization from the SHRA. Generally, a higher rent quote is applied to higher income bands because there's more income available to be to pay higher rent. So the rent quote is, if we just go back to the first line, the maximum amount of the maximum, it should say percentage of monthly income that can be spent on your rental. The rule of thumb over the years has been 30%, but overall rent quote, but that's now been refined in this to be a different amount for each different income band. So yeah, we're allocating in this instance, this example, 27% of somebody earning in that income band of 1850 to 3,500, and then average rental charge for that income band will be 722. It'll obviously be lower if people are earning 1850, and it will be higher if they're earning 3,500, but the average it will be 722. Same moving up. If the tenants are earning between 3,500 and 6,700, in this instance, 28.6% is the rent quote, and so the average rental for that income band will be 1,460. It will be calculated at that amount of 28.6 times 3,501 for people earning a 3,501, or 28.6 times 6,700, which will be a higher rental, but the average for that band 1,460, and it's the same kind of process for those in the secondary market. Does that adequately explain? I can't see the chat on my side, so I'm hoping that that explanation helps.
There is a thumbs up on that, so I guess
Nice. Okay.
suffices.
Good.
Yeah.
Nice. Okay, thank you. Yeah, if anybody doesn't understand, please stop us and we'll make sure that we get the best understanding across. Okay, so we've covered all the rental sides now. Now we're moving to operating costs. So direct operating expenses mean that all direct costs of operation and maintenance of the building. So these are related to that specific project. If you've got multiple projects, you'll find that your accounting system will split all those projects. They'll have a separate account number for each project. You must keep record of each project as a separate amount, as a separate division within your accounting records. That helps you keep track of costs for each property. Overhead costs are those expenses associated with running a business that can't be linked to creating or producing a product or service. They're expenses the business incurs to stay in business. So in your quick scan C, if you're on project number 1, I'm afraid your first project will have to cover all your overheads. If you on project 10, you'll only have the attributable section of your overheads relating to that project. So you build up economies of scale over time with this. But when you're starting up, there are those grants that help you cover your initial overhead costs. Okay, if we're going into the operating costs, we'll do the direct operating expenses. These generally vary with the degree of the occupancy in the building or directly related to operation of the building. Line items there are all listed: cleaning, fire safety, homeowners insurance, maintenance manager costs, meter reading services, provision for bad debts. You would enter your provision for bad debts in the yellow area in the middle here, your percentage. So we're using 3.5% will go in as the default. If you say you're going to have less than 2% provision for bad debts, you'll have to explain why you're going to achieve that. Generally, the best performers have very low provision for bad debts, which is below 2%. But there are some very high ratios there among the organizations which are unsuccessful, and part of the reason for being unsuccessful is not collecting rent on time. So, and that later are leading to bad debt write-offs. Then we've got a whole lot of categories here for repairs and maintenance. Now, these are the categories that need to add up to 1.02% of your capital cost. So it's these line items from row 136 to 143. And so if you see that your percentage in the summary is coming out to less than 1.02%, you'll need to increase one of these line items to get to 1.02%. Generally, you would have in your provision for preventative maintenance, you'll have a big allocation even in your early years, because you're building up your maintenance provision to take care of the big costs of major repairs that come later. So in this case, I can see what's happened here is we've got all these estimates. I mean, these estimates are just to populate the cells, they're not real amounts. So don't go and copy these into your quick scan C. But I can see what's happened here because we've got a very specific number in our repairs and maintenance other. We're obviously trying to make up to the 1.02% by you looking at that number. Sorry, we're jumping. Yeah, that was by accident. Right, so then we've got other costs, security costs, site-based office, if you have one there, water and electricity of common areas, any other operating costs. So this was, in this instance, we had operating costs as a balancing figure to reach our figure of 1,600, the sort of norm for operating costs. So this comes out of the case study just being done on a bit of a theoretical basis. There wasn't an actual project that we were copying to put in here. We just needed to test what we need to do to get to the parameters that we need to get to. So we're not going to go through line by line on this one. This is your overheads or indirect operating costs. The things starting from A at the top, accounting services, going down to W at the bottom, water and electricity for your head office. The type of business and head office related costs you'd have in here is accounting services, bank charges, computer software support, employment costs for your head office staff, employment costs for your project staff, say your caretaker, goes in the direct operating cost section. But yeah, you've got your other staff. Insurance, this would be insurance of the head office, not insurance of the property is a direct operating cost. So this is insurance of the head office, picking up a component of that. Postage and courier, marketing. If it's marketing specific for that project, it goes specific to the project. If it's general marketing, it goes under the overheads. Okay, now we get on to the capex sheet, one of the green sheets in the Excel file. And yeah, we've got got this monthly schedule that in this case goes for 18 months because we said we're doing an 18-month project in the example we chose. So generally your smaller projects would be shorter time. So the 8 months to 24 months is the normal sort of time period for these costs. And we'd get the line items probably from the quantity surveyors. Their cash flow they've given us for the development period, which is then set out on a monthly basis. The figures entered here should be excluding VAT. The model automatically adjusts for VAT, unvatable items according to the answers we provided in that VAT section we covered earlier. Land costs are typically incurred at the start of the project. Legal costs and commission payable also incurred at the beginning, itemized separately from the land cost. Insert any revenue and overheads incurred during construction, things like rates and taxes on the property, insurance, insurance during the construction phase, and any management costs during that phase. You'd insert them into this because they're all capitalizable costs related to the construction. And then we have a summary column for the total expenditure for the construction period, which is this column here, which is in the clear cells. We enter all our data in the yellow cells. So let's look at what we're doing here. We've got our total land and building cost in there. We've got some preliminary costs, which in this case, we've just averaged over the 24 months. In this case, we've got a total contractor cost. So we're going to spend 45 million, but we're going to start spending only in month 7. And then we've put in a flat rate here. Your quantity surveyor might give you a called an S curve or a sine curve. And you would put that in here that load the construction costs either start or finish depending on where you're expecting to have your highest construction costs incurred. Right, so I know that's very intensive to absorb going through like this. I think we should have a break. Also have some questions first, then we have a break. Any questions?
It doesn't seem like there are any at this stage. How much time do you want to take a recess for?
5 minutes. 5 minutes to clear the head.
Oh, actually, just maybe before that 5 minutes, I see some can I assume that all the R&M should be paid from the maintenance account? Did you get that, Larry?
I get that, but I'm not quite sure what they mean by the maintenance account. If you break down your R&M, you've got your responsive maintenance, which is, something's broken, send a plumber to fix it, that kind of thing. So that would be paid directly out of your ordinary bank account, just as a running cost. You would have your planned maintenance. Once we get into planned maintenance and major repairs, this is replacement of windows or doors, on a program where you have a life cycle, life cycle costing. Those kind of costs you would be making provision for every year, and that you'd have a maintenance. You should be setting aside a separate maintenance account. I think that's what the nature of the question is about. Those kind of longer term maintenance items, you you've already set money aside for that in previous years. So yes, that would come out of your maintenance cost, your maintenance reserve. If you've kept a separate bank account for it, which is best practice, that's when you would be settling your long-term maintenance out of that account. Does that answer the question?
Yeah, the comment is that yes, to a certain extent.
Okay.
I see there's a hand that has just come up from Kylie too. Just please unmute yourself.
Yes. Am I audible? Sorry.
Yes.
Yes.
Hello. Yeah. So I just wanted to be able to check on my side. So in terms of like, let's say you're collecting all your rentals and stuff like that and your deposits, would it be suitable for you to be able to, does SHRA allow you to be able to sort of set up a fund, like where you're contributing and you're taking out that money from the rental contributions and etc. to be able to save for long-term maintenance costs and things like that?
I can answer that one. Yes, the best practice is to take that the money you haven't spent this year on maintenance. So if you've bulked up your maintenance costs to get to 1.02%, I'm just putting the maintenance on the screen here now. So if those line items between 137 and 143 don't make up your 1.02%, you would be putting your provision, you would be putting aside the rest of it into a separate savings account you could call it provision for maintenance, long-term maintenance. And you should be generating enough cash out of your project to be able to do that. I know of one organization that does it. I'm not sure how many SHIs are actually putting aside that cash, but that's what's meant to happen. You don't need any help from the SHRA for that. You just open a separate savings account in the company's name, and you put the money in there, and you don't touch it except for maintenance. Yeah. Does that help?
Yes, it does. Thank you.
Yeah. All right. How are we doing for time, John?
There aren't any more hands, so I think we're good to take a 5 minutes. In fact, let's wrap it up. I mean, round it off to 6
So
minutes.
we
come back at 20 past. It's 20 past, yeah.
Okay. Right. Okay. See you at 20 past. Okay, are we ready to restart?
Good to go.
Okay. The one thing we haven't asked yet is how many people have had exposure to the quick scan C? How many have actually prepared a quick scan C before? Could we just have a show of hands? Just raise your hand in the next 30 seconds if you have previous experience of quick scan C. If you could just count the hands there, please, Tinashe.
It's just one hand.
Only one. Okay.
2 hands now. Yeah.
Okay.
That's it.
All right. Well, that's twice as many as the last quick scan C training course. So yeah. So we'll spend some time going through the Excel file itself after we've finished these presentation slides. There are not many presentation slides to go, so they're mainly just to show you and explain some of the background to it. So, okay, so the summary page is a blue tab in the quick scan C model, and it's where everything gets pulled together. So the first part of it is the top part of that sheet has got application and sources of funds. Application of funds on the left-hand side shows how the funds are being used on the project. So the first row there is the capex, and the second row is the overheads to be funded net of revenue during the construction. So there was a little bit of that in this particular instance. The third row is the net VAT, situation. So your net VAT claim or paid in the process is on the third row, as calculated in the model. Then we've got our financing costs in there. You'll see interest during construction. You'll see commitment fees. You'll see arranging fees. And then those, in this instance, they total 79 million. And then on the right-hand side, it's where we get the money from, the sources of funds. So we've got, in the case of an ODA, as in this case, we've got 16 million equity there, share capital, which is just over 20% in this instance. If there's mezzanine capital, which is shareholders' loans, that goes in the second row. And then the debt comes in from the third row. So we've got one long-term lender, and we're borrowing 6.6 million in this case. We don't need a second lender in this case. It's quite rare where we actually do have a second and third lender, because we've generally got the NHFC funding the balance of the funding, but they have in the past had agreements with other people to come in and fund alongside them. The biggest thing with the long-term debt is security of the property. So that's why you normally only have one long-term lender, because they've got a mortgage bond on the property, and you'll find that lenders won't lend to you unless they've got security over the property. And then we've got the grants further down. So in this case, the restructuring capital grant of 32 million in this case, and the provincial grant of 24 million in this case. If we've got any of those other grants that John spoke about earlier, those would go as a staff gear up grant. Any of those would go into this staff gear up grant line item. And then if we picked up any additional grants or donations, those would come in at the bottom. So there you've got your 79 million covering the development costs on the left-hand side. Right, now we get into the indicators. So for each of these arrows, that's pointing towards one of the indicators that Tinashe explained earlier. So going from top to bottom in the summary sheet, we've got basic information. So there's the number of housing units, number of primary housing units, the first indicator we need to fulfill is the percentage of primary market units as a proportion of the total. So there we've got must be minimum. In this case, we've got 30%. So a little green tick appears on the left of the box. These cells with the KPIs in have got some conditional formatting in them that tell you if you've met that criteria or not. If you haven't met it, it will come up with a red cross. So the next item down the list of the summary is the floor area, just a factual number. The floor area for the primary units. Then we've got the residential rental at the commencement rate. So that's your first year's or your first month's rent at full commencement. Then we've got monthly rental of primary units. We're looking here at an average rent of 1,331. So that should fit that criteria of not being more than 30% of the income in that area. We don't have a measure. Yeah, that's one of these things that's got the green tick, but that just is information that provides an overall picture. Then we've got one that does result in a green tick. It's a monthly residential operating costs at commencement date. So that's your first year's average operating costs per unit per month. In our case, we've got 1,544. Let's have a look. Let's follow the arrow back to the guidance. We've got average monthly residential operating costs per unit must be above 1,300 and preferably below 1,600. Now, why would we say it must be above a certain amount? Well, it needs to be at a certain level to be able to provide the services you need to provide. So you can't think you're going to provide excellent services and at 500 Rand a month per residential unit. You have to incur a certain amount of cost to be able to provide that service. So you'd want to see something between 1,300 and 1,600 Rand per unit per month here. So then if we go next line down in the table, we've got our maintenance costs as a percent of capital cost, excluding VAT and finance costs. And that's the 1.02% we've been talking about. If you're not achieving 1.02%, you go and review your maintenance costs. While we were going through the line items there, I mentioned that one cost that looked as if it was very specific. That was obviously the balancing number to get this up to 1.02%. So if we're not at that level of maintenance cost, it's either because we've got too little maintenance or our total construction costs are too high. So those are the two components of the formula. And then the last three rows are for information again. So our all-in development costs, in this case, we're coming to 600,000 per unit. As I explained earlier, we've got the subsidy amount plus a maximum loan of 100,000 plus in the case of ODAs, we've got owner's equity coming in. So that's why we can, as an ODA, we've got more scope to spend more on the unit and provide better quality and finishes and more things. Nicer playground, for instance, all that kind of stuff. So that in this case, we wouldn't be alarmed at seeing 600 there because we know it's an ODA. Okay, so that takes care of the summary sheet. So in general, yeah, if you're seeing green ticks, then your quick scan C is hitting the right notes. If you've got any red crosses, you know you need to go back and you need to go and change something, bearing in mind all the different factors that flow through to the KPIs. Right, and yes, a continuation of those summary sheets. We couldn't get the whole table on one slide, so yeah, we come to the if we go down the table first, yeah, we've got our all-in development cost, 13,500. That's our cost per square meter. The building cost itself 11,700 in this case. So that, and then we've got another section for project results where we've got our internal rate of return and debt service cover. Those being the two measures that really reflect the overall health of the project as a whole. So if we've got to meet that 16.25% target, in this case we've got it to 16.3%, 16.36%, so we meet that. But if we weren't meeting it, our process then would be to go through 3 steps. First, review your operating income and operating costs. So you'd review your rentals, your direct costs and overheads assumptions. You would tweak those. If that doesn't solve the problem, you would then go to reviewing your financing structure, so the debt terms. Try and get your interest rate down, try and extend your loan term if you can, if you're not already at the maximum. And our last one is to review the project costs, so review the development costs. Assuming you started off with your lowest possible development cost, you might have to do some re-engineering of your development cost as a last resort. That would affect your IRR. We're looking at our debt service cover, and that's got to be at 1.3. In this case, we've got a very healthy debt service cover at 2.48. And why would that be? That would be because this is an ODA where we're contributing 20% in cash equity. That means our loan requirement is lower. So generally your ODAs would be meeting your debt service cover quite easily. Your SHIs, that's usually your most constraining factor to generate net cash profit of 30% more than your loan repayments. If you weren't meeting that, you would have to go through the same process, review rental, direct costs and overheads, then go to reviewing your financing structure, then going to reviewing your project cost. So it's that order that of things you can control. Okay, now, in conclusion of this section, we've set out a number of reasons why your quick scan C might fail. So this is now from the assessor's side. This is the assessors providing feedback. First one, information not provided accurately. So there might be outdated information. It might be lacking a debt funding term sheet. There might, for ODAs, might be a lack of proof of equity, or that equity that's put in there has a loan attached to it, or a bond attached to a property if you put in property as your equity, or there's no elemental estimate of costs. So this is all up to the applicant deal with these, with those if it's related to the information not being met. Another aspect of why the QuickScan C fails is it does not meet key performance indicators. So it doesn't meet the project internal rate of return of 16.25% at current stage. It doesn't meet your debt service cover ratio of at least 1.3, or your maintenance reserve requirements not 1.02 of building cost, or your operating costs are too low to allow proper management of the project, guideline of 1,300, or they're too high. If you've got very high operating costs, you're also not going to be viable. So if you're coming in at 3,000 Rand per unit, let's say, for operating costs, there's no chance you're going to have a viable project. So it's operating costs being too low or too high. The third main category of why QuickScan Cs fail is because we've got costs that are too high, causing financial pressure. One is on your capex costs. If you've got capex costs of, say, 800,000 per unit, well, there's no way you're going to have a viable social housing project. Or, as I've just mentioned, unrealistically high operating costs. There's some municipal entities with incredibly high operating costs who only stay in business because the municipality gives them a nice big operating grant to pay themselves higher salaries. So nobody else has that luxury. And I think that concludes the presentation slides. Let's have some questions before we move on to the Excel. We'll then go through the Excel file and show you what we've been explaining on the PowerPoint slides. Any questions?
Okay, we've enabled your mics. Let's see if there are any hands. And then we move on to the next section. Just see if there's anything on the chat line. Nothing new there as well. I don't see any hands coming up, Larry. I guess all was clear. Oh,
okay.
Wait, not so fast. Letu says. All right, Letu, let's hear you. Please unmute yourself. Just unmute your mic, Letu, if you can hear us. There we go.
Okay, thank you. Am I audible?
Yes.
Okay, so I don't know if this question fits this particular section, but this is just an issue we're dealing with currently. If not for this section, then we can handle it later. But the question is about an ODA bringing in a new shareholder into their entity. How does SHRA, if a new shareholder was coming into the entity and bringing capital in, what happens to the equity in terms of funds that the ODA held already? Does that equity flow back to SHRA, or does the ODA keep it? How does that operate?
Okay, thanks, Letu. I can answer that one. No, if it's equity capital being added in the ODA, that stays within the ODA. That equity is never the SHRA's property. The SHRA's portion is the restructuring grants only. So that stays as equity contribution. It would be up to the equity shareholders in that ODA to decide how much of the company, how the shares are split after the introduction of new capital. but that could all be considered as share capital, and you would just enter the amount of equity coming in as your owner's contribution. You know, that 20% that you meant to that 20% of total project cost that you meant to add.
All right, thank you.
Does that help?
It does help. It does help. It's a little bit different to what we thought earlier, but it does help. Thank you.
Yeah, it's all, that's an internal company arrangement between the shareholders of the company. How you raise that, as long as there are no strings attached to that you've got that being, you know, funded by a loan that you're going to have to repay. You know, that's got to be real equity in the company. So, yeah.
So, for example, if the new shareholder is buying up more shares than the equity contribution of the initial ODA, so that, say, for example, the new shareholder is buying, say, 49% of
the company.
Yeah.
Now, you would only need to attribute the portion of up to 20% of the project, unless that, if that arrangement is about that project. But if you were selling 49% of the company, and the amount that the new shareholder was bringing into the company was going to be more than the 20% of this project, you would only need to put 20% of this project into the QuickScan C.
Okay. One last question, if I can complicate it. If let's say subsequent to construction, the project is at tenanting stage, does that make a difference?
Well,
in other words, construction has completed.
Have you submitted a QuickScan C before? Would this be the first application for funding?
No. So this is an arrangement now in terms of shareholding at the ODA, but the accreditation has long been done already.
Okay. So you've got accreditation as an ODA.
Yes.
You've got accreditation as a social housing provider via ODA. But have you received a restructuring capital grant from the SHRA?
Yes.
So you've already done all of that?
Yes.
As an ODA. So then you must have satisfied the criteria already.
Yes.
Of the 20% equity.
Correct.
So all of that would be, that's after the event. If you are bringing in a new shareholder, I wouldn't see any reason to object. You're not pulling out. It doesn't look like you've pulled out that 20% equity in the project. You haven't withdrawn that, have you?
No.
Yeah. So this is just an internal arrangement between the shareholders of the ODA.
Correct.
I don't know if there are any requirements from the SHRA's side to be advised of a change in shareholding. I haven't encountered anything like that myself. Maybe somebody with current knowledge of the SHRA's operations, John or Tinashe, might be able to provide an answer, but I don't think you would need to involve them at all.
Okay.
So yeah, that's an interesting case. I've also haven't come across it also, but what it speaks to is some level of exit from the shareholders who originally applied for grant funding with the addition of a new shareholder.
Correct.
And I think that there are, John, correct me if I'm wrong, but there are policy, there is some sort of policy around exiting that you as an applicant would need to be aware of. I'm not 100% sure what it is, but there is some, but I think that really refers to when you are looking to exit in totality. In this case, it doesn't look like you're exiting in totality. It's just like what Larry is saying, an internal shareholder arrangements that are changing. So if that is the case, then I don't think there's much that you would have to do, because it's not a complete exiting of your social housing portfolio.
Correct. Okay.
Yeah.
John, do you
Thank
have
you very
any
much.
feedback on exiting?
Yeah, there is a policy on what you call stock disposal, and I don't know if it does to a certain extent addresses the issue of changing in directorship. I was also quite tempted to, because I've sat in a few of these meetings where recommendations are made of projects to be approved forward to the council. And you do see that, just on the issue of change of directorship, that there is a level of consideration. With what Tinashe mentioned earlier, that this being government's program, there is an intention to also achieve certain transformational objectives through the program. So even as you do such transactions where there are new directors, I would suspect that something like that would have to be communicated at least to the SHRA, because it cannot be that on one point we are speaking to Letu, but 6 months down the line in implementation, it is now John that we are dealing with. But yeah, I thought I should just sponsor that, just from observation, really. I am not sure at this point whether it is a definitive requirement, but yeah, upfront at the approval of a project, there are those considerations, and sometimes it becomes a requirement that you display a transformed profile of the directorship.
Okay. Thanks, John. I'll just add a last comment about that, that you mentioned the stock disposal policy. If there was a stock disposal, there'd be arrangements to repay the restructuring grant, but it wouldn't affect the share capital. It wouldn't affect that equity capital portion. The most you would have to repay would be the capital grant, and the formula applied depending on how long you fall short of the minimum period required to hold the units for. So you would be repaying the grant only if you were exiting from social housing. Okay, we'll move on then with the case study. Right, so this is the summary sheet that we've just been through. Let's start. Let's work from left to right. The first sheet you get is the overview. Tells you, gives you instructions of how to use the model. So takes you through the color coding that's applied to the different sections. You're only able to enter anything in the yellow areas. The rest is all out of bounds. If you try and put anything in there, you'll be told you can't. It would be nice to have sort of a little area where you can play and you can do your own calculations, but maybe that'll come in a future version of QuickScan C. At the moment, there's a total block on anything that's not in a yellow cell. Maybe we could put that forward to the QuickScan C custodians to add a little workings area that people could do their own calculations in, or put supporting calculations in. If there are comments and instructions, they're in red. Just looking through the rest of it, there are just instructions on what goes into the different sheets, a bit of a description about what's there. So, and then there's some assumptions here that are entered by the SHRA. They'll be able to provide, they update these from time to time. So, and there's the sources of where they get the information from. But as was in the color coding scheme, anything in blue is entered by people at the SHRA whenever these change. And so, yeah, we've got those same subsidy amounts that you saw. Those have been recently entered. There's the relationship of 30 to 70 primary versus secondary. There's the grant retained until the final drawdown. We earlier were talking about income bands and the spread and the rent quote. So let's try and change one of these. Oh no, we can't. You see, we can't touch those. So that's all entered by the model custodians at the SHRA. And I've tried all the passwords I could possibly be, but I can't crack it. It's under strict lock and key. And some more description stuff, which we won't go through now. You can read through all of that when you are actually doing the model. I suggest that you read through this stuff on you go through it so you get a good understanding of what's there. Tells you what your supporting information needs to be. You remember one of the reasons for failing QuickScan C was supporting information not being sufficient. So yeah, it explains all of those. So we won't go through all of that because we've been through it a few times already. So the last time this was modified was 22nd of September. This would have been after that circular. So if, for instance, the VAT rate changes, then a new one will have to be done, and it will then be circulated. Remember the two green sheets, the general inputs and the CapEx inputs. So the general inputs, you've seen these on the PowerPoint slides. They copied from here. And we just change these as we go through. Some of them have got little data validation boxes where you've got a limited number of selections. Yes and no is obviously easy. So then we go to the equity contribution amount. There we go. If we've got shareholders' loans, we enter those in there. Then we've got the debt section. That gets, all those are entered there. If we've got a second loan or a third loan, there's space to enter those in that area. Scrolling down, we wouldn't normally have any changes to the grant retention funding. Just leave those as they are. Leave all these other things, defaults, just as they are. Don't let them worry you. Only change fields where you are actually need to make a change. So you remember the VAT information field. We're looking at that. We looked at that earlier. So let's see what a difference it makes if this goes to no, right? This is an ODA, and we're saying we can't reclaim VAT. So we're answering the question 2 there, VAT reclaimable on VAT on capital expenditure, no. And let's see what the summary tells us. In this case, okay, it's gone there. Facility, okay, we added facility of 15 million. It's meant we've needed to borrow more. So you remember our total costs here was 79 million before. It's now 88 million. So we've added 9 million to the project. This project was meeting these criteria quite easily before, but look what happens if we don't have VAT registration. So we then we're not meeting the IRR and we're not meeting the debt service cover. So we then need to go and revise a few things, and we then go through that 3-stage process, look at our operating costs, look at our financing arrangements, look at our look at our development costs. So in this case, we've got those criteria not being met. So I think this is a good opportunity to just go and see what to do to put those right. So let's first go to our general. Okay, I'm not going to do that right now. I'm just going to go through the general. Just go through the inputs. Later on we'll do the case of, we'll go and change that back to no, and we'll do the case of what do we do to make a project viable. So let's just go through the initial stuff first. So yeah, we've got our rent quotes. If we wanted to change any of these, we can change them, I think. Yeah, we can change them. But when it comes to the evaluation, we would have to have a justification to the assessors why we're not using the rent quote that was entered by the SHRA in the overview section here. Okay. We can change that, but there again, we're going to have to provide justification why we've changed it from the SHRA's default. We would normally have multiple types of units being allocated to each income band. But in this case study we've just kept things really simple. You recall yesterday we had that project of 132 units, so we've just used those same parameters for this just to provide some consistency from the quick scan B to quick scan C. The top row of these tables is the unit size of that unit. So don't get confused about that row looking the same as the others. It's a distinct piece of information, and you've got to put your square meters into the top row of the primary section and the secondary section, and then you've got the income bands in there. Okay, and yes, right, we are now back to being able to do this. Yeah, you enter your vacancy rate there. So if we were expecting a vacancy rate of 10%, you'd probably see your summary information not meeting the criteria. There you go. You don't meet your IRR if you've got such a high vacancy rate. So you see everything flows through. Let's just revert that back to where it was. We've got some commercial. In this case, in the case study, we said we've got one unit and it's 50 square meters and its revenue is 1,000 Rand per month. That was just to have some numbers in there. In this instance, we've got some units which don't qualify as social housing. Now, remember we said yesterday when in the quick scan B, you've got to have self-contained units. So they have to have a bathroom and a kitchen or kitchenette. If we've got rooms with communal bathrooms and communal kitchen, as a lot of accommodation in the inner city Joburg is provided, that doesn't qualify as social housing. So we've populated these fields just to illustrate, and this will flow through as a separate income stream, but won't be classified as social housing. We enter our commercial interest rate, commercial vacancy rate, sorry, comes in there. Then the next section is other income. We've got many rows of other income. In our case, we are entering parking income. Number of parking bays, we've said there's a 50% parking ratio. It's 132 units, so we've got 60% there. You see, we've entered you can enter a calculation, so that we've done. We got detailed input from the last meeting of the parking bay is 13.75 square meters. So, and we're saying we can rent those out for 200 Rand a month. Then
Larry,
we go into the detailed operating
maybe
costs.
before Larry, hi. Before
Yes,
you
hi,
proceed, there
John.
is again a request on the chat line
Okay,
to explain once more the income spread.
the income spread. Okay, let's go back to that section. There we go. Now there's a very wide income band that can qualify for social housing. So from 1,850 to 22,000. And there's no hard and fast rule over how that income spread is. The only rule that applies is that it's 30% of the social housing units are in the primary target market. So that's in the top section here. And that 70% are in the secondary market. That's the bottom section. Regarding the income spread itself, all that we need to ensure is that there is a spread. Now, the spread can be determined by many things. The first is your market demand. Where is the demand for which income levels do you have in your area? So hopefully your market study would have told you where your potential tenants, what they're earning and how much they can pay on rent. So, and this spread, yeah, we can change it as we want to. We could make that 10% there and 20% there. We satisfy our 30% criteria. But you can't go and put, you can't go and put 70% all in here and maximize your income, because I don't think the SHRA is going to approve that. They'll look to see that you've shown there's a fair spread across that goes across the whole income earning range of your target market. So what we've done is we've just used the defaults here that have been entered by the SHRA. Let's see if we try and change one of those defaults. No, we can't. I don't know the reasons of why these were set like they are, but if we want to have a different income spread, we do that in the yellow areas on rows 76, 77, and 81 to 83 of your general input sheet. Does that answer the question?
There is a confirmation that it does.
Excellent. Okay, so let's move on to these operating costs then. So you'll see that the way that the model is formatted and the instructions behind it don't allow you to land anywhere on the clear space. You can only move from yellow space to yellow space. So don't worry if you find you're pressing your cursor and it's not moving the way expected to. It's not that your computer is not working, it's just the way that that this was set up. So what we've done here is in this case study, we've just gone high level on everything because we were testing the boundaries on where your maximum levels of costs and things are that's still meeting the criteria. So we wanted as few items to change as we could have. So if you entered a quick scan C like this, I'm sure that Tanashi and the other assessors would send it back to you and say, please give us a more realistic estimate of what you expect to spend. So don't use this as your example. You see, we're using balancing figures and figures to get to figures to achieve certain targets. So the first one here, that default is at 3.5% for your bad debts. Let's see what happens if you enter 2%. It does allow it. So you're allowed to vary that and it won't break anything. It will give you better results. You'll still be meeting everything. But if you went and you entered 10%, there's your provision for bad debts. Let's see what it will do to your. Okay, so you're still meeting you've still got 5 green ticks. So you'd still be okay. But you would, if you push that to a much bigger number, you would see that you are not going to meet any criteria. There are some places with horrendously bad collection, and I'm quite sure that these will. Goodness me, this project is so healthy it can even accommodate such a high bad debt rate. But don't think that's always going to be the case. You want to keep that bad debt write-off as low as you can. In this case, remember we said the provision that 1.02% is the total of rows 137 to 143. In this case, we've put it all there, and we've just gone the easy way and said 1.02% of our capital of our capex inputs, just purely for illustrative purposes. And yeah, we're getting our operating costs up to an acceptable number. We've said 1,550 times 132 units times 12 months, less all the other costs above. That should get us back to our operating costs figure. If we look on the summary, it doesn't come exactly to 1,550, but it's pretty close, 1,544. So we are in that zone where we need to be. Right, so then if you've got any other costs that we are not specified in the line items above, we can add those all here. If it's a maintenance cost, extra maintenance costs that's not above, don't enter it here because it won't form part of your 1.02%. You must then enter it probably under repairs and maintenance other. Then we get to our overheads. These are overheads attributable to the project. So if we're on project number 10, you might want to put 1/10 of your overheads into here. And any new people you're appointing, new admin clerk, or new, because you've now got more workload, you would add on the whole of that new salary into here, but generally you'll be spreading, you would just have this project's own, this project's contribution to your overheads. If your project number 1 and a brand new housing association or brand new ODA, yeah, I'm afraid you're going to have to enter all your overheads, yeah, because you've only got one project to pay for your overheads. That's where these other grants and things will hopefully provide you some relief. So in this case, we've got overheads forecast. We've said we are doing a factor. It's not, don't use that as any form of guidance at all. It was just to have a number populated in this field. So we entered 300 times per unit times 132 times 12. It could be any number that's more realistic. Yeah, you've got your utility charges. You put those in. If you're going to be recovering costs, they would be looking at this if you've got a recovery percentage in there. So here's your utility cost recovery rate. Generally now people are using prepaid meters, so this is much less of a thing. It used to be a big thing when social housing first started, before prepaid meters were invented. Your grants, we've got the grants pre-entered already from the other side. If you were getting any of the other staff gear up grant or additional grants, you would enter those in here. These are the grants that John mentioned. You'd enter that here, and it would appear up. It would appear then in your summary. There's a section there where your grants should appear. Let's see if they do. Additional grants, staff gear up grant. There, it's 100,000. So it does flow. It does flow through. And then we've got a little summary at the bottom here, as that you can use as your guidance. You see here we've got that operating costs. We were trying to get to 1550 total operating costs, with 1250 being direct operating costs and 300 being overheads. Once again, don't take that don't take that as a guide. Those are just entered as numbers to fill the fields. If we've got a big commercial section, if we've got big commercial operating costs, we would put a percentage there of costs allocated to commercial. But it would be very rare that you would use that, so I'm not even going to pursue that. Right, let's move on to the CapEx input. So you remember the total cost of land in the example that we used was 6.6 million. Here it is. That was all inclusive. You'd normally put in your legal fees and your transfer duties and things you would put in. Yeah, normally we've just put them in as a lump sum. And they would generally all be in the first few months of your project, if not right up front in month 1. Let's move on to building costs. So we've got many line items for building costs, going through all the usual types of the split of the different skills and professionals involved. So you can add new ones only in these areas where the yellow cells are. If you want to change those, I don't think you'd be able to. No, you can't change anything in the clear cells. So you're just going to have to stick with the line items here. We've just populated a few just to just for the illustration. Right, if we go to the bottom, there are two sections to this. The top is just your building costs total. Then we've got a lot of other capital costs that also form part of this. So if we're paying for bulk services, we'd have to put that in. That would normally be very early in the project. We'd also have to pay NHBRC enrollment fees. I've forgotten what the percentage is, but you'd be able to get that guidance from your own sources. Then this bottom section here is normally just populated with the words other -specify. And so those, you'd have some other costs coming in. So we've said bond raising fee comes in when our loan is when our loan comes into being. When we get the draw down the money, the bond raising fee will also be raised. We just had assumptions on other general costs. In the case study, we've used this bottom row here as our variable for the different costs. I think you'll remember we said ODAs are going to be able to go up to 600,000. So there are a few calculations that went into this. In the examples you've got, these are all values, because I think it's just going to be too confusing to have these calculations put out there. But when you're doing your quick scan C, you will be entering these completely independently of this example. This is only just an illustration. So you would populate all of these, and if you hadn't populated them, the assessors looking at the quick scan C would probably come back and say, why haven't you populated this? Because by the stage you get to the level of where you're going to get funding, you're expected to know exactly what you're going to be spending your money on in the development phase. Yeah, the other professionals. So we've once again just lumped them into one row. Just very low compared to the norm. If we remember that norm of that Tanasha spoke about earlier of 8.5% to 12.5%, that you'd expect to see that sort of number in here. Generally, the professionals who've been helping with social housing projects have not always charged the full rate that the professional bodies say they're allowed to charge, but they get the return back from this because they generally are doing multiple social housing projects once they've built up the experience. There's quite a lot that's different to normal kind of building, so they need to know that stuff. So you'd always want to appoint somebody who has done social housing projects before. And then at the bottom, there's a bit of a contingency here. In this case, it was 4.34% to get to the figure we had in the Bertram's case study. Now, the bottom section, revenue during construction. You might say that's unusual, but it's not unusual if you're doing a project that's not being 100% occupied on day one. And you might have some commercial rental from a shop that's part of the development as well. Quite often, you wouldn't even need to have formal phases, but if you were doing a development of, let's say, 10 blocks of 3-story walk-ups, you might release blocks 1 and 2 in March, and you might release blocks 3 and 4 in June, and you might release blocks 5 and 6 in August. So to take account of those, your project's only finishing when all the blocks are let. So in that case, you would say residential rent. To spell it properly, although you don't want the quick scan CSSs to turn down your project for a spelling mistake. So let's say we're getting to the end here and we were going to earn 5,000 in that month, and then 10,000, and then 15,000, and then 20,000. So that you could be showing that as income. You might have some related operating costs as well. So you would have your normal company management going through. Yeah, you might have some project op costs. I'm just going to call it project op costs, but you probably have security, all that kind of stuff. So yeah, we're going to have, say, 2,000 there. We're going to have 4,000 there. We're going to have 6,000 there. We're going to have 10,000 there. So you might have that sort of profile. Don't forget about this section. Don't disregard it. Previous experience with the quick scan Cs show it has quite an impact on meeting your KPIs if you're very close to the line. And you're reflecting your expectation of being able to earn some income while you're releasing the blocks that are finished first. This 18-month period, yeah, you know, the building period, or whatever your building period is, that is until the project is finished. So you might have lower costs here at the end once you're winding down and you're doing some snagging and stuff. So try and get your monthly allocation of costs and income as accurate as you can. Okay, so let's have a look. Everything still is there. I'm just going to leave those few figures we've entered. I'll just leave them in there. I think we've been through the summary sheet. As with enough explanation for you to have a basic understanding of it. You might need to read through it again just to make sure you get an understanding. What we didn't do is we didn't do the use of cash. Yeah, we didn't look at this graph, but this graph is telling us where our cash is going. So we've got operating costs being in this mid blue color here. Interest paid is the red part. So we see over the term of the operation of the project. This is 20 years, not 20 months. This is the running the project as operating capacity. Our interest decreases over time. That's just because the loan is amortized in that way. To have your early payments consist mostly of interest, and over time your proportion of capital compared to interest in your repayment is higher. So this is just the interest component that reduces your actual cash payment of the loan repayment would stay constant. And so here's the principal repaid on debt. So the red plus the stripy one just above it, that's your total loan repayments. And this is your revenue here on the top line. So with inflation over time, your revenue, you can increase your rentals by CPI normally. So with and you would do that once a year at a time. You put that in the loan in your lease agreement, all of that, so you can increase your rentals in proportion to inflation. Here's the retention capital grant funding. That's this graph. So as you get your grant funding released through the construction process, you're building up this little retention amount here, which then gets released at the end. So you had an 18-month construction period, it's released in month 18. And this, is a comparison of our project IRR to the cash flows over 20 years. These are your net cash flows. You see early years, you are paying out lots of cash to fund for your development, and in later years, you're generating increasing amounts of operating cash flow. And over time, that's what your project IRR shows, and it increases and becomes positive over time.
Perfect. Thank you very much, Larry.
Okay. Right. So that's the summary, and that's where it's all contained. You're all about avoiding red crosses in this section here. So that's that. These are assessors to check this side here. There are varying degrees of the other models, the other sheets in the model you don't look at. They are locked, and you can go through these at your leisure to see how things flow through the model. But that's the sort of the hidden part of the model, which you normally wouldn't see. But in this case, they are allowing you to see how the things are broken down. And some assessment tools would probably consist of your 2-input sheet and your summary, and you wouldn't see any of the background. Yeah. Okay, are there any questions? I think that's covered what we needed to cover in terms of the case study. Does anyone have any questions at this stage? No questions. That's amazing.
It doesn't seem like it.
Either
but
everybody's asleep, John, or they're fully knowledgeable now. One of the two.
I guess it's all going in because I see you also have a measured way of delivering these things. But on the chat line, Isaac is asking, so the grant covers the purchase of land as capex. I don't know if you've attended to that already, Larry. The question is, so the grant covers the purchase of the land as capex. Is it enough to have identified land and provide a signed OTP as confirmation that the land is available?
Okay, I'll answer that one. There's got to be certainty that that land is going to be that deal's not going to fall through. So an offer to purchase doesn't guarantee that you're actually going to get the land. It's certainly a very strong indicator, but I think before any you would probably need to have more than just the offer to purchase to release the grant. Now, I know you might want the grant to buy the land, but it's a question of risk. And I think the SHRA would look at the whole package and see if there's any risk of the grant of the land deal not happening. So they would probably send an assessor to make double sure that you're not going to have any hiccups, and they'd want to see something more than just an offer to purchase. Do we have any Do we have any increase on that offer from Tanashi or John, perhaps?
Sorry, Larry, you were saying, I missed that last part.
Yeah, now I'm saying that the offer to purchase would be the absolute minimum, but there would still be more assessment need to be done to make sure that it's a real offer to purchase that's going to have that's going to be binding on the seller not pulling out and the buyer not pulling out. I think you'd need to have more than just the offer to purchase.
Yeah, in fact,
before the grant could be released.
Yeah. In fact, we have had our fingers burned now that you're actually raising this, where an applicant was approved for CCG, and this was based on an OTP for a building here in the inner city, Johannesburg. And I think it was just at the point of trying to close on a few items on conditions precedents, if I recall, that the seller then pulled out, and the whole transaction and deal had to be revised. I'm not sure in terms of, coming out of those lessons, what has, for example, the team in the project development and funding implemented in trying to mitigate against such risks. But I think going forward, it is something that we are quite mindful of. We've spoken at length yesterday about the nature of OTPs in terms of their lifespan being quite short-lived, because when you compare them to the whole approval process of the SHRA, sometimes and often at times that lifespan is outlived by the process. So yeah, it is something that we usually try and caution the applicants on as well. And where it is possible to get those renewed, I think that's an advice that is given on case by case.
Thanks, John. Does anyone have any more questions about the maintenance? The earlier question about the maintenance was explained and understood to an extent. Do you have any other questions about the maintenance after going through the actual maintenance section there, Samkelisizwe? Okay, if we're not hearing back about the maintenance question, Isaac, you're asking maybe a long-term lease with the option to buy when the grant is approved. I think we're going to have to go along here with each case being assessed to see that it's not going to fall apart as soon as the money's released. So an assessment needs to be made about that.
You asked me a question with regards to the maintenance.
Yeah, were you asking about the maintenance earlier?
100%, yes, I was.
You're happy now with where you put it in the quick scan C? Okay.
Kind of, but the question I wanted to ask, ultimately, we've historically always paid everything from the one account, no?
Okay.
So there was a maintenance kind of bank account open, like a separate account, but I don't think sufficient funds were transferred there, but we have done a lot of work, but from our normal current account.
Yeah.
So now to comply now, so obviously it will be now to transfer the amounts, right? But I want to know what constitutes as the maintenance. You said planned maintenance. Is that just long-term maintenance or?
Well, the planned maintenance can be short-term and it can be long-term.
Yes.
It's, you would, if you've got a maintenance plan or a life cycle costing.
Sure.
Some places have got life cycle costing models where they'll have, they'll put in replacement of key items at 10 years, 15. I've seen maintenance plans lasting 60 years, you know, with roof replacement in year 60. So that would form part of your planning around maintenance. But as far as I know, there's no requirement as such to have this separate account in cash. It's just recommended as best practice.
Okay.
So, and you're doing the right thing by having a separate account and by using that to, you know, topping up to your 1.02% of capital cost, making sure if you've spent 0.5% of your capital cost on running repairs and whatever maintenance you've planned or done for that year, that other 0.52% you could put that aside into your maintenance, call it a maintenance provision account or a maintenance reserve account, and you then can decide whether you pay your next year's maintenance out of that account or out of your other one. But the principle is that you are either paying out or setting aside a total of 1.02% of your capital cost every year.
Okay.
It's to provide cover so that when you've got your big major repairs coming in later years, which in that year might be 2 or 3% of your capital cost, if you've got a big repair program, you know, then you use your maintenance reserve in that time. That's basically what it's for. So I'd say running expenses pay out of your normal current account, and long-term major repairs pay out of your reserve.
And also, the reason I'm asking the question is that there was a SHRA submission that had to be done. So ultimately, they were asking about the maintenance reserve, the reserve. I'm assuming they wanted the account, so the bank balance of the maintenance reserve. So now, would I then have to prove that these expenditures were occurring, but on that separate account, or what? Because they were specifically looking at that maintenance reserve account, if you will.
Yeah. I've not been involved in any of the monitoring on that basis like that. Perhaps we could get an answer from somebody who has. Silence. So yeah, I think
because I'm stuck now with regards to this submission, because I'm not sure if I have to prove that this is what we're doing, or they are purely looking at that specific account and the expenditure there on that specific account.
Are you what submission are you talking about? A quick scan C submission?
No. It was like a normal audit. They were doing a normal audit.
So the monitoring,
yes,
the monitoring tool. Okay.
Yeah, okay. I'm assuming so. Yes.
Yeah, I suggest you send them an email asking for clarification. I couldn't give you clarification from how they're monitoring it. I was involved last in monitoring stuff a long time ago. I suggest you just send them an email with that same question to get an answer. Do you have any other questions?
Well, there isn't anything new on the chat line, Larry, and I also still don't see any more hands. And I see we just less than 20 minutes from conclusion. How's the amount of stuff that you still have to go through? Is still quite a bit?
We're done with the stuff to go through. We've been through all the slides. We've been through the case study. As far as I think it's useful for people to get an understanding of it, but I'm happy to go over anything again if anyone wants a repeat or wants to look further into the depths of the QuickScan C model. I'm happy to go there.
So I think let's take those last concluding comments. It does look like we will indeed keep to our promise to close the session a bit more early than anticipated. But yeah, if there are those last minute questions, comments, please let us have those. We are drawing to a close, and I just wanted to just reiterate that there will be a mail shot which will come from my side with all the handouts. We've promised to provide you with a list of the restructuring zones. In fact, yesterday's mail shot came with that, but I'll just do a repeat anyway in case you missed it. The list of the PSCs, which we've talked about at length in terms of the significance of the projects having to go through PSCs in their respective provinces, will be part of the handouts that you will receive. I will also include the regulations and the Act itself. I think we've also promised to provide the IIG. Now, bear in mind that when we confirmed the session, we did send you the guides for all the modules that we covered, including the slides. But in the event that you have not received that, because I've had a few email returns and I couldn't make a follow-up, please do alert me so that I can retry and send those to you as well. But for now, those are the 4 or 5 items that I have noted as the follow-up handouts that we will send. I think because the session was recorded, you will also receive the links. I think that would then lead you to the recordings as well. I don't see any more hands or the few comments that are coming through on the chat line. Perhaps, okay, I see Loiso's hand is up. I will just perhaps enable the mics. And Loiso, if you can just unmute yourself and pose your question or comments. And then I see the few comments that are coming through the thing as we conclude. Loiso?
No, thanks, John. Am I audible?
Yes, sir.
No, mine is only just to check if the last session on the introduction to social housing have already distributed the handouts. Thanks for the other handouts about this project packaging. I didn't receive that one from introduction to social housing.
Yeah, thanks for that question. I am still consolidating everything. I think there's only one update that I'm waiting on the guide. And I wanted to just do a one mail shot on that. So give me a bit of a few more days. Hopefully before end of this week, that will also be on in your inbox as well. But yeah, it hasn't gone out, so you haven't missed out anything. I see a couple of hands that are already coming up, Lois. So if that is all, let us take Dumelo.
Quick one, John. I just wanted to find out from you, are there any other courses that are scheduled for the rest of this week or till the end of the year?
So this would be our last one for the year before the December close.
Okay.
The schedule that we published covered included a number of topics as well, and I did indicate that some of the topics, it does seem like we will not be able to deliver on in this financial year due to some internal delays and also some changes in the sector. So, but we will be communicating. Essentially, what we will be doing is on an ad hoc basis, we'll be coming to you with regard to definite confirmations on the topics that are going ahead. And for that, we'll probably give you at least 2 weeks notice ahead in advance. But yeah, for now, this one was our last one for this calendar year.
Thanks so much.
We come back, I think, with those of you who may have missed the introduction to social housing, we will come back and rerun that one in early in Feb. Okay. Last hand that I see is Figile. Figile, you want to pose your question or comment?
It's a very short question. Thank you so much, John, and thank you, Tinesh and Larry. John, my invitation came through at that party, and I don't think you will have my email address. And I'm thinking I may be missing on the communication you are doing. So I don't know if I can drop you an email after that so that I'm able to get all the communication and the documents that you're promising to circulate. That's one. Number two, I missed the introduction to social housing. I'm just checking if you are able to share those slides on email so that I can pick up maybe on some of the content that was covered there. Thank you so much.
All right. So direct answer is certainly. I think if you drop me your email, Figile, I will include you in this group and share with you the handouts for this session, but also the introduction to social housing ones. But you have an opportunity also to join us in the February one if you were not part of the first one that we did a week ago.
Okay.
Right. All right. Let me not then belabor the session
John, I see James is asking if you can get contact details. I'm not sure what the protocol is. If they should get those from you or what the protocol is there.
Happy to share my email address, johnm@shra.org.za. John M, and I'll put it up on the chat line. @shra.org.za. Now, there are specific process owners to this topic. These are the colleagues that are responsible for this process in terms of assisting you to register your project into the pipeline. The first is Shilombe @shra.org.za. And the second one is, if you got that, sure. The second one would be Sanele @shra.org.za. So communicate on email with these two colleagues. They will provide specific guidance with regards to your project specifics regarding your project per se. So those are the two additional emails that could be of assistance in terms of getting your project into the pipeline, and if it is in the pipeline, if there are any follow-up queries. If that takes care of that,
I think James wanted more email addresses, but I'm not sure if that's allowed.
James, if you are still within the call, maybe if that which you have shared is not sufficient, would you want to just indicate? But I'm not picking up James, so I assume that that is adequate for now.
That's fine.
Which we've shared.
John. I've sent them to the chat. Yeah, all the email addresses: Shilombe, Sanele, and Zanele, and yourself. They're in the chat.
Okay, great stuff. Okay, no, thank you.
Actually, James was asking for the consultant's contact as well.
Oh yeah, but we like I indicated, we can't provide that detail just simply because it does has potential to result into conflict of interest. As I indicated, we can't be a referee and a player. So we leave it to yourselves as applicants to source and identify such thing. We don't do such reference or referrals.
Clear, thanks.
Okay. All right. I do want us to conclude at this point, and let me take an opportunity to thank you all for taking time to join with us in the last 2 days. And also to Tinashe and Larry with the manner in which they have really helped us to unpack this content. I hope that the last 2 days has been useful, and that this would not be the last that we see some of you. You have our contacts, and so let us engage further. Lastly, to my team, Mandla, Tumi, Skumbuzo in the background, who has really assisted with the admin side of the program. Thank you all, and let us then adjourn today's session.
Thank you, everybody. Thanks, John.
Thanks, guys.
Thank you.
Bye-bye.
Thank you.
Bye.
Bye. Bye.